It's my pleasure to welcome you to this year's Financial Stability Conference organized by the Office of Financial Research and the Federal Reserve Bank of Cleveland. I can't think of any better way to kick off this conference than to hear from our President and Chief Executive Officer, Loretta J. Mester. President Mester has been actively engaged with issues of financial stability, both as a researcher, where she is co-editor of the Journal of Financial Services Research, and a founder of the Financial Intermediation Research Society, and as a policymaker, where she serves on the Federal Open Market Committee and also is chair of the Conference of Presidents Committee on Financial Stability. So please join me in welcoming President Loretta Mester. Loretta, the floor is yours. Unmute, please, and take it away.
So thanks, Joe, and I really appreciate that introduction, and I'm really looking forward to the 2020 Financial Stability Conference, Stress, Contagion, and Transmission, and welcome everyone to the conference. So as Joe said, this is a joint conference with the Office of Financial Research, and the Cleveland Fed and the OFR have been organizing this conference together since 2013. And the idea is really to bring together academics, policymakers, supervisors, and industry practitioners so that they can share perspectives on issues pertaining to the stability of the financial system. And of course, over that time span, there have been many issues that have arisen. So this year's program was organized by Joe Halbrick of the Cleveland Fed, who you just met, and Dassel Kim of the OFR. And if you look at the program, I think we'd all agree that we owe them a great deal of thanks for organizing such interesting sessions. I also want to take the opportunity to thank both of our keynote speakers, Federal Reserve Governor Mickey Bowman, who will be presenting this afternoon, and Marcus Brunemeyer of Princeton University. He's always an interesting speaker, and he'll be presenting tomorrow. So if you look at past programs of this conference, they've covered a wide variety of topics, including the changes to bank supervision and regulation that were undertaken since the global financial crisis, the relationship between monetary policy and financial stability, and the implications of fintech and financial innovation for financial stability. So that laid a really excellent foundation for this year's conference, which is focused on evaluating how effective the tools and approaches that have been developed over the past decade have been in promoting financial stability and financial system resiliency. And I think that's particularly relevant now because the pandemic shock has hit the economy hard. And as a result, the policymakers have taken actions to encourage banks to continue to lend to support the real economy during the pandemic. So actions include granting forbearance to large classes of borrowers in an economic environment in which credit risk has risen, relaxing certain capital and liquidity regulations, and relaxing some types of supervisory oversight. Now, these actions were able to be taken because of the overall health of the banking system going into the pandemic. And I think that reflects some of the success of the regulatory reforms after the great financial crisis in improving the resiliency of the financial system. Now, the actions taken by policymakers were necessary, in my view, to support the economic recovery. But at the same time, it's important to acknowledge that relaxing regulatory and supervisory policy to encourage banks to continue to lend involves making a trade-off between higher near-term macroeconomic stability and increased risk, possibly increased risk of future financial sector instability. And given the significant role the US financial system plays in the economy, I think it's particularly important to have conferences like this one that help us understand the implications of such policy actions for financial stability and resiliency. So this year's conference is looking at three different aspects of financial stability that I think are very relevant to our current situation. The first topic covers the interactions between macroprudential policy and monetary policy. Now, in addition to the actions taken to encourage banks to continue to lend, the FOMC has lowered its policy rate, the Fed funds rate, to its effective lower bound. And we're purchasing assets to support market functioning, which of course also adds monetary accommodation. Now, even apart from the pandemic, changes in demographics, risk preferences, and productivity growth have led to a decline in the general level of interest rates that are consistent with sustainable growth and price stability, and a decline compared to the level over past decades. So because of those changes in the economic environment, the FOMC undertook a review of its framework for setting monetary policy in light of the changes in the economy and released a revised statement on its monetary policy strategy this summer. And that revised statement explicitly acknowledges that stability, that if you want to sustainably achieve maximum employment and price stability, which are our monetary policy goals, you need to have a stable financial system. Now, I think it's important to recognize that there are interactions between monetary policy and financial stability. While monetary policy that leads to a stable macroeconomy encourages financial stability, it's also possible that in an environment with low neutral rates, a persistently accommodating monetary policy could, in some cases, increase the vulnerabilities of the financial system by encouraging higher levels of borrowing and financial leverage, increased valuation pressures, and search for yield behavior. So how best to approach that nexus between monetary policy and financial stability in a low interest rate world, I think deserves more consideration. Now, if you look at the January 2020 FOMC meeting minutes, which were in the part that talks about the discussion of the monetary policy framework, most FOMC participants agreed that supervisory, regulatory, and macroprudential tools, including the countercyclical capital buffer and stress tests, should be the primary way to address financial stability risks rather than using monetary policy. But in the US, we really have few countercyclical tools, and they're really not designed to address vulnerabilities outside of the banking system. Therefore, I think there may be certain circumstances where monetary policy may need to be adjusted in order to mitigate risks to financial stability. But when and how to do that needs further study. In addition, I think more study is needed of the trade-offs and complementarities among our three sets of relevant policies: monetary policy, macroprudential policy, and microprudential policy, which includes tools like the capital and liquidity requirements that work across the business and financial cycles. Now, as our framework review did with monetary policy, understanding the implications of a low interest rate environment for financial stability and how we can best use macroprudential policy, microprudential policy, and monetary policy to achieve our goals of financial stability and macroeconomic stability is a first order issue. The second topic of the conference is also a very important one, namely the fragility of markets. Turmoil afflicted the Treasury and mortgage-backed securities markets in March. Now, these are very liquid markets, but the liquidity didn't protect them from market dysfunction, which required action by the Fed to quell. These markets are critically important to the overall functioning of the global financial system, so it's critically important that we consider what types of structural changes are needed in order to make these markets more robust. And the third topic that will be covered in the conference is networks, interconnectedness, and the propagations of shocks. So, of course, essential to assessing the stability of the financial system is understanding how shocks, even those that may appear to be relatively small, can propagate across the financial system and create systemic problems. A cyber attack on one bank can spread throughout the system. Having playbooks that can be followed in the event of such an attack and tabletop exercises to test out those playbooks are an important part of preparedness for the eventual shocks that we're going to face. Now, of course, what the pandemic shows is that there can also be shocks that are severely adverse stress events that affect the whole system and the global economy at once. So it's important to understand the vulnerabilities of the financial system and economy to various types of shocks, both small and large. And I think this is especially important as the financial system is becoming increasingly interconnected and network effects loom quite large for new entrants into financial services. The entry of big tech firms into financial services deserves our attention. The ability of big tech firms to produce and to capture the benefits of big data depends on network effects, and benefits to users grow when there are more users of the services. And as the number of users increases, more data are produced that can then be garnered for use by the big tech firms for the development of new services, pricing, and marketing. So, a firm that may have begun as an e-commerce firm may find it beneficial to offer payment services as an adjunct to generate more e-commerce business. But the transaction data can then be used to offer more services, including financial services. Once a big tech firm is well established, it becomes more difficult for other firms to enter. So market power concerns, issues of pricing, cross-subsidization, product tying, other anti-competitive practices that lead to less innovation and potential financial stability concerns deserves increased attention from financial services researchers and from policymakers. And I think an interesting paper in the conference shows that there can be reverse flows as well. For example, we often ask how a decline in one sector of the real economy, for example, the housing market, can have negative effects on bank balance sheets that then propagate across the financial system. But there's going to be a paper in the last paper session by Casciani, Machiavelli, and Silva that really shows that the firm's access to credit can help mitigate propagation of a real sector shock throughout the real economy. Now, more broadly, the pandemic has underscored the important role a healthy financial system can play in supporting the real economy by ensuring that credit continues to flow to firms and households so that they can weather adverse shocks. Which brings me back to the start of my remarks and why I think conferences like this one can increase our knowledge and inform our policy decisions. And so they play a helpful role toward promoting a resilient financial system. So thanks to all the presenters, discussants, and attendees for participating and furthering our collective knowledge. I'm looking forward to the conversation. Now let me turn the microphone back over to Joe, who will set things up for our first session. Joe, the mic's yours.
Thank you, Loretta, for setting the stage for what I hope is a very interesting conference. In the past, we've had this conference both in Cleveland and in Washington, D.C. This year, of course, it's in cyberspace. So I want to take a few minutes to share some of the logistics and ground rules to lay the foundation for the rest of the day to follow. So in terms of the overview, attendees, when they join, are going to be in listen and view mode only. For the panel sessions, panelists are going to have 5 to 7 minutes for an opening statement. Then there will be 30 minutes of discussion led by the moderator. And hopefully we will have time for about 5 minutes of questions and answers from the floor. For paper sessions, paper presenters will have 20 minutes to present their paper, and the discussant will have 15 minutes to present, followed by 5 minutes for questions and answers. Between sessions, we will have short breaks to switch moderators and presenters. During the sessions, you can submit questions by clicking the Q&A button at the bottom of your screen. If you have a question for a specific presenter, please type the name of that presenter before your question. And you also have the opportunity to upvote questions if you see a question that you like, but you don't have one to ask yourself. Moderators will lead the Q&A portion of the session by reading the submitted questions or posing their own questions. For presenters or moderators, please ensure that you're muted and have stopped the video when you are not presenting. Conversely, please ensure you are unmuted and have started the video when you are speaking. Please be in gallery view so you can hide non-video participants. And this is important because this will allow you to see the timekeeper, so we stay on time. Click the share screen at the beginning of your presentation and stop sharing at the end if you have slides to share. We are recording today's sessions and will post them to the conference website. All of the conference papers are available to view on the website. And a link to that website was included in the conference reminder emailed to you this morning. As with any virtual conference, there's a potential for unexpected issues, so please bear with us. Now, our first panel is macroprudential and monetary policy, and it's moderated by Andrew Atkinson. Andrew is the Stanley M. Zimmerman Professor of Economics and Finance at UCLA. Welcome, Andrew. Take it away.
Joe, thank you very much. Thank you for inviting me to moderate this panel. We are going to have 4 distinguished panelists. I think you'll be able to see 3 of them. One of them is having a technical issue with his camera. So I will introduce, as Joe laid out the agenda for each session, we're going to have a short presentation from each of our 4 panelists. We will then have a discussion and with 5 minutes of Q&A at the end. Again, for the audience members, you will see the Q&A button for you to pose questions in the lower, at the bottom of your screen on the right-hand side. And please be sure to look at those questions as they come in and upvote them so that all have an opportunity to choose the most pressing questions for our Q&A session. But let's kick this off. The panel is about macroprudential policy. As President Mester pointed out, we want a system that is resilient to shocks, and this pandemic has certainly been a shock. I'm thinking about myself. March was a terrible fright, and even now we have a lot of uncertainty. Speaking for myself, I'm not sure what I'm going to do for Thanksgiving 1 week from now. I imagine many of you are in the same situation. In such an environment, it's hard to plan for regulation and capital policy and market stability and all the rest of that. So I think we'll hear about these issues today. Our first speaker is going to be Hugh Carney, who's the Vice President of Capital Policy at the American Bankers Association. Then he will be followed by Andreas Lehnert, Director of Financial Stability, Board of Governors of the Federal Reserve System. Then Dorothy DeWitt, Director, Division of Market Oversight, Commodity Futures Trading Commission. And finally, James Chapman, Deputy Managing Director, Economic and Financial Research at the Bank of Canada. So thank you to our panelists. Hugh Carney, please go ahead.
Thank you very much, and thank you everyone for being here today. First, I would like to thank President Mester, the Cleveland Fed, and the OFR for the invitation to be here today. As already noted, the current environment is very different than 10 years ago. The shock came from outside the banking system, and what started as a medical crisis became an economic crisis. However, due to high levels of capital and liquidity and solid risk management, the banking sector was able to absorb the shock of the first few months. Over the following months, the health crisis has persisted, and the economic recovery has revealed itself to be longer than initially anticipated. In this environment, the banking industry has kept credit and banking services flowing. Banks have absorbed a surge of deposits, maintained lending, and are working constructively with borrowers. Related to deposit growth, the industry saw over $2 trillion in deposits surge into the system in the first half of 2020. The influx of deposits is attributable to a general flight to safety, changing savings patterns, businesses shoring up their own liquidity, and the US government response. 6 weeks after the CARES Act passed, the banking industry saw 120 million economic impact payments flow through it in the form of direct deposits. Through direct deposit arrangements, individuals were able to receive their payments faster and more securely than those receiving checks or prepaid cards. The influx of deposits led to significant asset growth of more than 2.5 trillion in the first half of 2020. This includes loan growth of more than 4%, capturing nearly 500 billion in PPP loans originated by banks between April and August. Using the flexibility afforded by regulators, banks have been working with borrowers who are unable to make payments. Large financial institutions disclosed 330 billion of loan modifications. This amount equates to approximately 6% of total loan balances for these firms in the second quarter. Banking agencies facilitated these efforts by enacting a series of targeted temporary relief measures that allowed banks to absorb economic stress and facilitate the broader government response. Of particular note, on the supervisory side, the banking agencies clarified that prudent efforts to modify terms on existing loans for affected customers will not be subject to examiner criticism. They instructed safety and soundness examiners to consider the unique nature of the crisis and to exercise appropriate flexibility in their supervisory response. These steps have sent a message to examiners and bankers alike, and that is, do not make the crisis work. Keep credit flowing. In addition, on the regulatory side, growing balance sheets meant that banks faced pressure on leverage ratios, the potential breaching of regulatory asset thresholds, and potentially higher deposit insurance assessments. Again, the regulators developed targeted temporary relief measures to ensure regulatory requirements did not disrupt banking services. In many ways, the story of the banking industry in this crisis has been one of resilience under stress. The stresses on the economy as a whole, while significant, were not as bad as they would have been without the fiscal response from Congress and financial stability measures from the Federal Reserve. I'm looking forward to discussing these issues further during today's sessions. Andy, I'll turn it back over to you.
Thank you very much. Andreas, please go ahead with your presentation.
Thank you, Andy, and thank you to the organizers. I remember the earliest iterations of this conference were held in the Martin Building's infamous Dining Room E at the board's headquarters in Washington, D.C. And I look forward to the day when we can all once again meet in person. So I'll base my remarks on the financial stability report that the board published last Monday. It covered a range of topics, our usual assessment of financial vulnerabilities, as well as a bunch of special topic boxes that touched on our emergency lending facilities, a deep dive into the March turmoil, Andy, that you mentioned, a LIBOR transition update, and a couple of other kind of normal sorts of boxes that we include in every report, as well as one on climate change. So let me just touch briefly on two elements of the financial stability report. The first is our appraisal of our emergency lending facilities, and then the second will be our assessment of kind of where we are in terms of key macro financial vulnerabilities. So start with emergency lending. In March, at the in the midst of some really record financial market turmoil, the Fed took a range of actions designed to protect the economy from those stresses. These included augmenting or creating mechanisms to support global dollar funding markets. That's the swap lines with international central banks and the FEMA repo facility, large-scale purchases of Treasury and agency MBS and CMBS securities, and then a host of emergency lending facilities created under Section 13.3 of the Federal Reserve Act. These emergency lending facilities, I would describe them as coming essentially in two flavors. First, there are kind of what you might call usual funding market lender of last resort emergency facilities. So that's the commercial paper facility, the money market facility, the primary dealer facility. And then there were a set of facilities that were more novel and designed to promote the flow of credit to employers. So when we were sort of thinking through that set of facilities, we surveyed the waterfront of employers and determined, that each major category of employer should have, in principle, a facility that was backstopping them to prevent kind of a liquidity squeeze or some sort of technical default from eroding organizational capital and employment relationships. So, you had state and local governments, small, medium-sized enterprises, large corporations, and then issuers of asset-backed securities, which can be a combination of all of those. And so that's why we set up the Muni facility, the Main Street lending facility, the corporate credit facilities, and TALF. So did they work? As we describe in our report, the announcement effects were very powerful in calming financial markets, particularly those which households and businesses depend on. Our facilities haven't made very many loans, so total assets across the Muni facility, TALF, Main Street, and the corporate facilities come to just about $24 billion. But by being backstops, by being present, should market conditions worsen, they assure market participants that, market conditions aren't going to become so dislocated that borrowers are totally frozen out. So that $24 billion has to be compared against the nearly $2 trillion in corporate, muni, ABS, and leverage loans that have been issued since the market's nadir in late March, early April. And so, of course, all of this issuance has taken place at record low interest rates. Second, the current state of financial vulnerabilities in the United States. I won't run you through the whole assessment, but for fans of our financial stability report, that we track essentially four major vulnerabilities: asset valuations. Second is debt owed by businesses and households. Third, solvency of financial institutions, including banks. And fourth, funding risks. We just highlight our findings on I think two of the more interesting vulnerabilities. First, business debt, and then second, the resilience of the financial system. So in business debt was high coming into this crisis and jumped significantly as businesses borrowed to get through the pandemic-related shutdowns and declines in income. They needed to do this in order to maintain capacity for the eventual economic recovery. And doing so, helped avoid the deadweight cost of bankruptcy. So under normal circumstances, when you see a big jump in debt to GDP, that's normally a source of concern, or it's a potential vulnerability in the system. But there were some mitigating factors here. First, a big part of the jump was in Paycheck Protection Program loans, which can be forgiven. And it looks like there was a lot of precautionary borrowing to put cash on business balance sheets. So if you look at debt, but net out cash on the balance sheet, that's actually declined recently. Finally, interest rates have fallen substantially. So all of this debt is a lot more affordable. But, this is obviously something to keep an eye on. And, if business income sort of remains low, there's the potential for excess, business failures and bankruptcies to stress the system. So resilience, and then finally, just wrapping up resilience of the financial system. Hugh did a fine job of describing the resilience of the banking system. If you look back 12 years ago when we had to manage, a big shock in the form of, the subprime crisis, on top of a bunch of insolvent financial institutions, it's exactly the kind of headache that you don't need when you're dealing with something like this. The other sort of piece of financial system resilience is funding markets. And so this was an area, particularly with money market mutual funds, where, we again saw some, pretty serious strains that required intervention. So with that, I'll turn it back to you, Andy. Thank you.
Thank you very much. Dorothy, please go ahead.
Thanks very much. Let me just get started here. My name is Dorothy DeWitt, and I'm the Director of the Division of Market Oversight at the CFTC. The CFTC is the most important regulator you either may not have heard of or may not talk about at the dinner table regularly. I run a team shy of 100, a bulk of which are economists tasked in identifying emerging market risks to inform and develop policy for the Commission. The US derivatives markets are approximately 500 trillion notional across futures, options, and swaps. Most cash markets in financial products such as treasuries, equities, credit, and commodities such as agriculture, metals, and energy have well-established and well-integrated derivatives markets. The CFTC and the Division of Market Oversight's role is to promote the integrity, resilience, and vibrancy of the U.S. commodities derivatives markets through sound regulation. As I said, the CFTC is the most important regulator you may not think about all the time. That is because commodities derivatives we oversee total 400 to 500 trillion notional and range from corn to crypto, with interest rates, certain credit default, and swaps and Forex derivatives, in addition to, as I said, metals, energy, and other more traditional commodity derivatives. We have direct oversight of derivatives on these commodities, and we have fraud and manipulation jurisdiction over commodity spot markets. So we track both very carefully, and that tracking will inform some of the observations that I'll walk through today. As you may know, just by way of background, in 2008, Congress expanded the CFTC's remit through the Dodd-Frank Act from traditional commodities derivatives to swaps, such as Forex and interest rates. That Dodd-Frank Act was 2008 and implemented through 2010. I should correct my dates. Among other things, Dodd-Frank reforms required central clearing for certain types of instruments and data reporting in certain situations for much of the derivatives that we regulate, enabling us to have a view of emerging and existing market risks to financial stability in our markets, which are global in scope. Now, Mike Tyson once said that everyone has a plan until they get punched in the face. Well, in 2020, COVID-19 punched us in our marketplace in the face. The top line takeaway is that our markets were tested in terms of volume, volatility, and liquidity arising out of a health pandemic. Unlike 2008, in which a crisis arose out of a an issue from the financial markets themselves. But at the end of the day, the takeaway is that our markets worked. The pipes flowed, margin was met, and the entities we oversee by and large adapted and performed as expected. But let's get into the details, focusing on fixed income and rates, credit, ag, crude, and gold. During the pandemic, as with the cash markets, derivatives markets were all affected. In March, the CFTC staff pivoted to working remotely and while monitoring and addressing market risks, coordinating with other federal agencies that oversee the cash markets and providing relief or guidance as was required. Turning to fixed income and rates, the fixed income derivatives markets and the equity index futures markets at first dislocated before converging in the face of risk aversion. For example, as you may well know, the 10-year US Treasury bond futures yields were approximately 1.8% at the end of 2019 and fell to 1.5% in the end of January and 1.15% at the end of February. Conversely, S&P index futures remained resilient through January, reaching a new high on February 19th. At the same time, market risks across our derivative markets began showing signs of increasing risk aversion as liquidity fell and the level of open interest and open positions moderated from this point onwards. The VIX index futures, around 14.5 in February 19th, rose to an unprecedented level of 90 mid-March as markets struggled from the pandemic's economic effects. March 2020 proved to be a roller coaster ride for US interest rates. In the wake of plunging stock markets, we initially observed a precipitous decline in US Treasury yields as investors brought safe havens in less risky assets. The yields on the 10 and 30-year Treasuries briefly reached their all-time lows on an intraday basis of 31 basis points and 69 basis points, respectively, in the second week of March. As you know, the Federal Reserve responded with large purchases of US Treasury securities and 2 interest rate reductions for a total of 150 basis points to a range of 0 to 25 bips, where it had previously been for 7 years following the financial crisis. The spread between the 3-month LIBOR and overnight index swap rate, often seen as a barometer of stress in the banking system, swelled to 138 basis points by the end of March, which is the widest reading that we've seen since the financial crisis that began in 2008. One of the most surprising factors was the widening in spreads traded between long-term cash treasury securities and the futures contracts which track them, usually referred to as a basis or relative value trades. This was accompanied by a sharp, short-lived upswing in treasury yields, even as equity indices continued to fall, reflecting the termination of many such basis trades as some investors sought liquidity. There was also a widening between bids and offers in some of the most liquid cash futures and swap instruments, reflecting lower liquidity levels. In addition, measures of implied volatility on options contracts based on interest rate swaps, often seen as a gauge of risk, reached their highest levels since 2009. However, in the months since then, most spread relationships have resumed more normal pre-pandemic levels. Equity markets have rallied, as I'm sure you followed, day to day, and interest rates have risen on the potential for more fiscal stimulus and on news regarding vaccines as investors anticipate an economic recovery. Let's turn to credit. Credit markets experienced significant volatility and notable outlier events from corporate credit to municipal markets, particularly in March and April. In particular, the highly liquid credit CDS markets experienced a spike in the swap and swaptions markets during this period, at a time when the underlying corporate bond market liquidity was experiencing challenges. According to IHS Markit, total untranched CDS index trade volume for the CDX investment grade and CDX high yield indices were 4.82 trillion and 1.4 trillion respectively in the first half of 2020, a 59.29% and 53.16% year over year increase also respectively. The liquidity of the CDS indices supported elevated volumes on CDS tranche markets as well, with tranches on the CDX IG and CDX high yield indices seeing 48.49 and 102.4 increase year over year at 21.7 and 18 billion traded in the first half of 2020 respectively, per IHS Markit. In short, that's a lot. Municipal debt markets experienced similar volatility, with both the taxable and tax-exempt municipal bond markets considerably impacted by COVID-19 as respective bond market indices declined by double-digit percentages in March before reversing towards the end of the month. Additionally, the SIFMA municipal swap index rate spiked to about 5.2% of the week of March 18th, and well above both 1 million and 3 million LIBOR rates. 1M and 3 million LIBOR rates, a notable market anomaly. Just for context, this SIFMA municipal swap index is benchmark rate for tax-exempt variable rate debt demand obligations, and it typically trades at a fraction of LIBOR as it accounts for income tax benefits associated with tax-exempt variable rates. Municipal debt relative to the tax LIBOR. For the most part, these broader credit marks have reversed their losses. And I'm going to skip through just a little bit to go to ag to make sure that I'm not taking into other people's times. So starting in the first quarter of COVID-19, we saw significant chaos in the ag markets, both on the supply and demand side. As a result, the markets observed multiple price anomalies, heightened volatility, and increased dislocation. There were logistical problems and demand shifts that quickly created a buildup of certain livestock products, including milk and bacon, and saw drawdowns of others, including ground beef. And I myself, as a daughter of cattle farmers, have observed this market and have observed in our community how this has affected folks on the ground, our ag constituencies. The livestock supply chain faced unprecedented challenges due to worker illnesses, packing plant closings, and reductions in processing. During the spring, about 36 livestock processing plants closed due to COVID-19. The duration of these closures ranged from days to weeks. It was estimated that pork and beef processing capacity due to closures and employee absenteeism at the plant fell by approximately 40% during March and April. As livestock processing plants struggled during the spring to remain open, the wholesale cash and retail values of meat surged. At the same time, livestock and futures prices fell sharply, leading to large spreads between the values of processing facilities' inputs and outputs. we saw live cattle hit a 10-year low, down more than 35% in the spring, and we saw lean hog futures fall as much as 40%. In recent months, the markets have stabilized, and products and the supply chain has also begun to stabilized. I'm going to turn briefly to WTI crude or the oil markets. As you may know, the oil markets faced an unusual confluence of events, including fundamental factors such as a slowdown in the economy, overproduction, and a real slowdown in demand. You may also know that there was a real shortage of storage globally as crude storage ships floated offshore globally seeking to absorb that capacity. You may well know that the NYMEX's WTI crude contract on April 20th closed on the penultimate day of the May contract at approximately negative $37, only to rebound the following day. What I will say, I'll skip past this, because what I will say is that the chairman, Heath Tarbert of the CFTC, to whom I report, has indicated that the CFTC staff, yours truly and others, will issue a report on the activity on or about April 20th in WTI crude shortly. I will turn briefly to the gold market, which was significantly impacted as well, particularly during March and April. Prices fell sharply during the sell-off with elevated volatility. Established price relationships between major trading centers also changed, and with a large dislocation between physical gold prices in London and COMEX gold futures in New York developing in late March as lockdowns in Europe and the United States resulted in major refineries closing, restricting access to gold depositories, and the virtual cancellation of air travel between London and New York. I'm going to take just a quick moment to look at how much time I have left, or if I've gone over time from our timer. I don't see our timer, so maybe you can just let me know if I've gone over time or if I have another minute or two.
You've gone a little bit over.
Okay, so I will then conclude. What we did see is gold normalizing at this point, and if you're interested in seeing the no action relief and guidance that we've provided throughout COVID-19, that's available on the website. Thank you so much.
Thank you very much. James, would you like to go ahead? And if you want to share slides, please do that.
Okay, can you hear me?
Yes.
Awesome. Okay, so I'm sharing my slides now, although I seem to, can you see my slides?
I do not at this time.
Okay. Somehow this says, uh-oh. Okay, Zoom seems to have frozen for me here, so I'll just talk through them. The slides were just mostly structures, so I could keep on. Sorry that you can't see me. I had a last minute computer change to a computer without a webcam. So I'll just talk a bit about sort of future issues, that is CBDC and fintech, and what their financial stability and macroprudential implications could be. So first, of course, I'll say, naturally, these views are my views and not the views of the Bank of Canada, not necessarily the views of the Bank of Canada. And first, I'll start with fintech. So fintech, as you might know, is basically just the integration of information technology into the financial service sector. And we've seen a lot of that recently with things like robo-advisors, P2P lending, distributed ledger technology, which was quite a hot topic a few years ago. Now, all these things are sort of standard technological change in the financial sector. So robo-advisors are basically just automation of advisory services. Distributed ledger technology is basically just a back office technology that potentially can make things more efficient. So in some sense, they're interesting. There are some interesting implications in terms of cost structures, but they're not disruptive, and we don't have to think of them in terms of, in my opinion, in terms of the financial stability implications, because they're basically just sort of business as usual for banks. What is potentially disruptive are digital currencies and CBDC issuance. Now, so these are potentially disruptive technologies, And why am I bringing this up now? It's because part of it is because the whole COVID pandemic has accelerated trends we've seen in the past. So since COVID, for example, has started, we have in Canada, according to recent surveys, the percentage of people who have no cash in their wallets that percentage has increased between 15 to 40% over the last couple of months, and the amount of online commerce has grown by a good multiple, at least in Canada. So these are areas where payment technologies are sort of new and innovative, that is digital currencies and other online types of technologies. In addition, we've seen in the past year the announcement and sort of slow rollout of Libra, which is a payment technology offered by Facebook and along with a consortium of other mostly tech companies. And this shows that there's potentially a sea change in terms of payment technologies, which will have some disruptive effects on the financial system. And in addition, you've seen increase. Not in addition, but because of this, you've seen a increase in the work around a central bank digital currency, or CBDC. And a lot of this work has been done collaboratively across central banks. So, for example, in the recent report that was issued by 8 central banks and the BIS, which include the Bank of Canada, we had a discussion about a central bank digital currency. That is, we termed it as a digital payment instrument denominated in national unit of account that is a direct liability of the central bank. Now, this is a potentially interesting technology for financial stability questions, because the way a central bank digital currency is designed has lots of implications for the business of banks, as well as how the everyday life of payment users. So a lot of these decisions that have some effect, for example, would we design a CBDC as an account or as a token? So an account would be akin to a bank deposit, whereas a token would be sort of closer to a cryptocurrency or crypto asset like Bitcoin. Would it be available to all citizens in the country, or would it be mostly a wholesale instrument? I mean, this has questions around the financial stability implications around, let's say, bank runs and sort of the deposit business of banks. Two things to think about in terms of what President Mester mentioned in her opening remarks is a lot of these digital currencies that are currently being thought about, for example, like Libra, they're being offered by for-profit enterprises, big tech firms. And one of the reasons they're developing these things is for basically harvesting data and sort of getting a better measure of what consumers are doing, so that they can increase their profits. So another design question around the central bank digital currencies is privacy and security. And security is also related to resiliency. You know, these digital currencies could increase the operational risk inside the financial system if they're not designed well, and how they are interoperable across borders and domestically also has financial stability questions related to, say, flight to safety or bank runs or sudden stops if the digital currencies got large and were easily movable across borders. Now, let me turn here. So these financial stability and monetary policy implications basically come down to the role of digital currencies as money. And so, we remember from our economics 101 classes that money has basically three economic roles. That is a means of payment, a store of value, and a unit of account. And I think we can slot each of these, the financial stability and monetary policy worries and potential opportunities into these three areas. So starting with the first as a means of payment, cash, if you think of a current central bank currency, but not digital currency, it acts as essentially the outside option for different payment schemes and therefore supports the efficiency of payments. A consumer always has the option at a store to pay with cash, at least until COVID. Now, the other thing that they use for to make payments a lot is basically bank deposits via like debit cards or whatnot. And the financial stability implication of a digital currency in this aspect comes from the potential of a change in demand from bank deposits to a CBDC. So we have to worry about what effect does a digital currency have on bank deposit demand, especially if depending on its ease of use. A second economic role is basically store of value, right? So the cash and insured deposits are essentially risk-free stores of domestic value, and a central bank digital currency is another possible store of value. And one thing I should mention here is folks on this panel have talked a lot about the financial crisis. An older innovation was money market mutual funds, which were also supposedly a risk-free store of value until they weren't in the financial crisis. And as an aside, bringing this to the current world, Libra, the way Libra is being designed, to me looks somewhat like a money market mutual fund. So we have to think about what effects that would have on say deposit demand, and also what effects it would have on bank investments. So there's been research at the bank and other places about central bank digital currencies and what effect they would have on the lending business of the financial sector. And some recent work both by some Fed economists as well as some Bank of Canada economists shows that if banks have market power, there might be a increase in lending because this provides a competitive aspect. But on the other hand, that also means that there might be some search for yield in the banking system if a central bank digital currency is, or digital currency in general is widely used. And on the final aspect, in terms of the unit of account, that's also something we have to think about for digital currency, because that's ultimately the most important aspect of the role of money, because it's the foundation for monetary policy. And in this respect, some of the things we have to think about for a digital currencies or especially a CBDC is what, if any, interest rate do we charge? Would a central bank charge on a digital currency? Would it have negative rates? And also, there's some recent research which shows that this also might have some financial stability implications, because if you have a digital currency, it might make bank runs easier if you don't have the appropriate policies. But this also depends on what level of interest rate the monetary policy stance is. So for low interest rates at the effective lower bound, for example, CBDCs might make the financial system more fragile because of the ease to move back and forth between a CBDC and bank deposits. Although I think some of these bank run risks around a CBDC are potentially not as worrisome as we thought, because it really comes down to what a central bank would do with the increase in assets coming from an increase in issuance of CBDC. If they have a well-established lending program back to the banks that are suffering outflows in some sort of crisis, then I think a CBDC would probably not be a risk, but could be an opportunity, because it would eventually, essentially act as a way to protect investors, retail investors, from a financial crisis. Although that would mean that the central bank would be on the hook for a lot of liabilities. And also, my final slide had a nice picture of our digital currencies and fintech landing page for all our research. I can say it looks really nice, but you can't see it right now. But I encourage everyone in the audience to go to the Bank of Canada's research tab to look up more of our digital currencies and fintech research, because we published, I think, something along the lines of 24 analytical and research works in the last 11 months on this area. And with that, I'll turn it back to the moderator. And I don't know if I can mute myself now, because I think my Zoom has crashed.
Okay, James, thank you very much. And thank you to all four of the panelists. I think we've touched on a great many of the issues that President Mester said in her introductory remarks. There were the issues connected to basically the banking system and regulators working together to support lending, for the recovery, the interaction, dealing with the turmoil in financial markets and with non-bank financial institutions, and how that interacted with financial stability. And then some of the future risks or concerns that we have about financial stability coming from, basically non-bankers moving into the banking business, whether that be a central bank digital currency or fintech companies doing that. But there is a point in her remarks that I'd like to follow up on and have our panelists speak more on. And that was about the trade-offs between, supporting the macroeconomy or the economy now versus, planting the seeds for financial stability in the future. And so one of the things that maybe we didn't discuss so much was that obviously regulators have engaged in a series of additional stress tests with banks. And my understanding is a big part of the purpose of those additional stress tests and, quarter by quarter decisions on bankers' ability to pay out earnings is to establish confidence in the public that this trade-off is being managed well. So I'd like to ask our panelists about, what is the role of transparency in this stress testing? I can see one has to balance in an uncertain environment, regulators want the flexibility to kind of make decisions as they see events develop. You have bankers who want to have some certainty about how they're going to be regulated. And then, of course, you have the public that wants to know that these two things are being, what is driving the trade-off between the two, and how we as the public should understand that. So I would like to have our panelists, comment on this trade-off and how it's going.
I guess I'll start off. When it comes to the public and the banking sector, I don't view there being competing objectives. The banks and the public have to understand how banks are being evaluated and why the restrictions or penalties are being applied. In the last round of stress tests, we deviated from what had been developed through a long process of notice and comment and the establishment of the stress capital buffer. And I think for the public and for the banks, it's better if at this stage in the process, we just let the system work as it was designed, rather than put in new restrictions with kind of no clear understanding of how or when those restrictions will be lifted.
Does anyone else want to comment on that?
Andy, very briefly, one of the, I think you touched on one of the really big benefits of the kind of the stress testing regime, and a kind of a signal lesson of the previous financial crisis is the value of a stress test as an authoritative kind of evaluation of the resilience of the financial system, one that depends on, in particular the core banking system, one that depends on, independent, models developed and run by supervisors. And so that, that permits a degree of transparency and insight into, the risks and potential losses faced by the banks, as well as, kind of the supervisory posture toward the banks. I think this was our first, the COVID crisis, the pandemic, was the first real test of that kind of post-crisis framework. And as Hugh said in his remarks, I mean, I think really demonstrated that the banking system came into this crisis pretty well capitalized, certainly relative to where we were 12 years ago, but also vitally important to maintain the kind of public understanding, especially at a time when you had a bunch of relatively novel risks, emerging. So I think, the transparency benefit of the kind of stress testing regime, seems to have been, I think, pretty successful in the current episode.
Well, if I might follow up on that with a question, so I'll be speaking from my own perspective. I myself have tried to, struggle with this question of what is the use of market signals in terms of informing us about, I'll call it financial market resilience and banking system resilience in particular. I look at the Federal Reserve's supervision and regulation report. That's obviously a different report than the one that Andreas puts forward on financial stability. And in there, I see that they include market signals about banking sector health. They show credit default swap spreads, or an average of them for the banking sector, and a measure of banking sector capitalization based on the market value of equity rather than the accounting standard values of equity capitalization. And when I look at those market indicators, the ones on the market leverage look concerning to me right now. The market leverage is at historically low levels, largely because most banks are trading at market to book levels, well below 1. And so this means that the market assessment of their equity cushion is not so different than it was, in the middle of the 2008 crisis. There is not much commentary from the Federal Reserve on that observation, despite the fact it's published in that report. Do you have any guidance on how we should interpret that piece of data?
That's a great question. I think the kind of very robust use of market prices and financial market signals about the health and risks of the banking system, was a kind of a key piece of the post-crisis supervisory framework. Obviously financial markets are aggregating a bunch of information about, the future cash flows of banks. They're they do have some effect at the, with some indirect effect on bank cost of funds. And so they can tell you something about, in a direct way about, whether banks are going to have to pay up in order to raise deposits or funds. And then they're the foundation for, for a range of measures like COVAR or S-risk that have become really important signals of overall financial stability. they have to be, there are limits to what you can extract from financial market prices. You mentioned the fact that price book ratios are low, or that the market equity ratios are low. I think that in part reflects investors' opinions about cash flows generated by banks across the set of future outcomes out there. And they're no doubt reflecting expectations about interest rates. A time when all of those measures looked incredibly healthy was in 2006, when ex post, the banking system turned out to be incredibly fragile. So there's kind of all of these prices have built into them as well, the physical probabilities as well as a kind of a risk premium associated with them. So we could talk much more about this, but I think the main takeaway is that you can look at something like a CDS spread and get a pretty clean read on people's evaluation of solvency risks, which tends to be extremely low at the moment. And some of these other measures, I think, because they reflect investors, evaluations of and taste for particular kinds of risks, have to be taken with a bit of a grain of salt.
You go ahead.
I tend to agree that there are limits here, and while market leverage measure shouldn't be ignored, it should not be taken as a direct measure of banking fundamentals. Existing evidence strongly points to a system in which banks have significant levels of capital to withstand losses, so they can continue to serve the economy as they've been doing for the last 9 months. The stress tests, I think, have shown that so far.
Okay, excellent. Thank you. I mean, another issue that I'd like to ask about, a hallmark of the 2008 crisis was, the funding risks that came out of kind of the shadows, shadow banking. And there was a lot of concern about derivatives markets and how those might, create problems. We've discussed that there was turmoil for a couple of weeks in March there, and then the Federal Reserve actions managed to kind of hold that off, I would say, and markets calmed down. Are there any lessons from what happened in March for what we might want to do differently next time? Yeah, Dorothy, please go ahead.
Thank you. So I'll answer that question slightly differently. And as you know, our markets are just a little different from the banking sector. So probably this will be by analogy more than directly. It's a little less of a lesson and more of an implementation of a lesson plan that we had been planning to do for a while. So the Division of Market Oversight implemented a number of rules. In fact, the agency implemented 20 rules, final rules during COVID, and 30 overall in the last year and a half. And one of the key ones that we had been working on for a number of years and finalized in September was the swap data rules. There are 3 of them. And in short, we implemented these rules that created more transparency in data, more clarity about what data needs to be collected and how it needs to be collected, and simple things like format that's more usable. But very importantly, those swap data rules were the result of collaboration with international bodies that also developed monitor swap risks. And alongside us, so that we could have data be usable across the board globally and see where risks are developing in a very different way from what happened in 2008. So just wanted to mention that we finalized that. We are implementing that over the next year or two. And that if folks are interested in hearing or learning more about the additional and better data that we are collecting as a result of those 3 rules, about 900 pages that we finalized about a month ago, be happy to chat about that offline, because I think that's really instrumental in driving our ability to monitor risk going forward on a global basis.
Well, thank you very much. I see time is flying, so I'm going to just put one more question to the panel. If you think historically, and you read Friedman and Schwartz, the problem in a financial crisis in the past was that basically you had a big outflow from the banking system into cash. And then in 2008, to a mild extent, and in this event to a much larger extent, we've seen the reverse, that resources have flown from the rest of the financial sector into the banking sector. And you talked about the big expansion of balance sheets and some of the regulatory issues that it created. And that, I think, was kind of new in terms of our thinking about what happens in a financial crisis. But then James' presentation on central bank digital currencies raises the specter that we could go back to the old pattern of, in a financial crisis, resources would flow out of the banking system into some alternative store of value that was perhaps viewed as more safe. What changes to what we do with either regulation or planning for financial stability do we need to make to be ready for a world where in a crisis, banks could get smaller, banks could get bigger, and we might not even know which way they're going to go? Does anyone want to comment on that?
Could I comment on that?
Yes.
Okay, perfect. I'm on my phone now, so I can't see anything. Yeah, I think you raise a good point about the how this would be in a world with CBDC. And I tried to mention that at the end, because I think like the Great Depression, like you mentioned, people moved to cash, and there was no way to take that liquidity and move it back into the banking sector. Whereas I think if we move to a world with CBDC, then at that point there would be if there was a flow out of the banking sector into central bank liabilities, that would increase the central bank liabilities, and they'd have to offset it with some asset somewhere, which would be, I think, in terms of to shore up the system, would be lending it back to the banking sector. So really, what we would have to worry about in a future world where there's outflows into digital currencies, we'd have to make sure central banks have facilities to recycle that back into the banking sector in an efficient way, right? So the central bank would effectively be the intermediary between the banking sector and nervous depositors. And I think the other thing to think about is that if a central bank digital currency is in a foreign currency, then I think that's a big risk for say a small open economy, because at that point you can't do that. You just have movement out of your financial system into another financial system, and there'd be no way to recycle that liquidity back into the banks.
Well, thank you. We don't have much time for Q&A. I'm going to take one question out of the Q&A. This is from Bill Nelson. All the jurisdictions that were able to do so lowered basically their capital buffers. Were those cuts successful in boosting the supply of bank credit? The answer to this question could help inform a much needed debate about the effectiveness of the capital and liquidity buffers that are an integral part of Basel III. Would any of you want to discuss that?
Bill asks an excellent question. I don't have a fantastic answer for it. Different countries had activated their countercyclical capital buffers and switched them off. I think, the overriding, and I think, we're all going to be studying the short and long run effects of that. The US with a very much a market-based intermediation system, is critical to get the kind of bond markets working again. And it was a great relief not to have to worry about an insolvent banking system on top of everything else.
All right. Well, I think we are at the end of our session. I'd like to thank all four of our panelists. Thank you very much. And I hope the audience, the attendees, have found this to be an interesting session. I have for certain myself. So with that, I think I turn it back to Joe Halbrich, I believe, to take over to set up for the next session.
That's right. And I'd like to thank Andrew, Hugh, James, Dorothy, and Andreas for a lively and insightful panel discussion. We now have a 10-minute break where we'll move on to our next session participants to present, and we will return at 9:50. That's 9:50 for the next session. Thanks, everyone. See you soon.
Thank you.
Hi, Philip. You just need to unmute. We can see you.
Yes, can you hear me as
yes.
well?
Yes,
Okay.
now we can hear you. Do you have, do you want to practice sharing your slides?
Yeah, why don't I do that? So let me, 1 second.
Perfect.
I think that works fine.
Yep. And then you can go to the top of the screen and, yep, stop share. And then we do recommend that you be on gallery view so you can see the timekeeper. So you'll receive a timekeeper notification at the, you'll have 20 minutes total. So you'll get a notification at 15, 10, or sorry, 10, 5, and 1.
Yeah, so 1 second. So I think since I'm the moderator slash
I'm sorry.
I think I have 15.
You get 15 minutes, yes.
And the office each have 20, I believe.
Yes, so you'll get a notice at 5 and 1.
So if they go over time, I'm the one supposed to rein them in. Is that correct?
Sure.
Okay.
Yes, you have the power.
Do we have all that? I see Florian.
Yep. And Florian, do you want to, I'm pretty sure the whole panel is here, the paper. All right, there we go. Florian, do you want to practice sharing your slides? And you can unmute.
Hello, Philip. Thanks, everybody. Yeah, maybe I can quickly start check sharing my my screen as well, if that's okay.
Yes, go ahead, please.
Actually, I'm just going to put myself into gallery view, okay, and then share screen.
And remember to hide the non-video participants as well.
Yep, I did that. So do you see this?
We do.
Yes.
Can you put it in like full view?
No, I can't because I tried this before calling myself on Zoom, and if I put somehow it wouldn't show. I mean, if I put this in full screen, I can try. I mean, maybe there's something. It's just me, but let me try full screen. Do you still see my slides?
We do. It looks like it's a duplicate right now. You can just leave it how you did it originally.
Yeah, because I think somehow it just, I don't know. So I prefer going this way. Actually, let me just get rid of this stuff all here and then.
Yeah, perfect.
How do I hide the non? I'm trying to do what you just told me.
Yeah. So right now, do you see a lot of black boxes with names in them?
I see your name.
Okay. Yeah. So go ahead and go into my videos where it's black, and there'll be 3 dots that pop up in the corner of my screen of my little video.
Yeah.
And then it says hide. Yep. Hide non-video participants.
Got it. Now it's just see Florian.
Okay. Perfect.
So we don't have Manoush on yet, huh?
She was on and just dropped off. So
let's see.
So
because
I
was making sure, trying to pronounce the name correctly, and I want to make sure we're sure that it's right. I might mangle it anyway, but at least I want to try. Florian's rolls off a little bit easier. At least rolls off my tongue a little bit easier. Okay. And Florian going to go first, and then Manoush going to go second.
That's what I recall.
Sounds good. And Jana, maybe just briefly on this instructions you sent out, there was something about the Q&A that I shouldn't type an answer or press the answer live button, and that you want to get a question. So my understanding is participants who will ask a question, they can unmute themselves and ask the question, or are there any questions which are going to come in via chat, so I have to read them out?
Right. So at the bottom of the screen, during the session at the beginning, it's helpful to remind people to put in Q&A questions for the session. Okay. And then when you open the panel, you'll see once there's a question in there, there's a couple of options that you could say answer live or type the answer. Don't use those. Just if you're going to choose one of those questions, just read the question so people on the attendees can hear it and people in the live stream can hear the question, as well as our recording.
Okay, but should I expect all the questions to come in via the Q&A feature, so I have to read them out?
There will be questions that will come in there, yes.
Yes, because otherwise it's just us asking questions.
Correct.
Nobody else going to be, or maybe Joe or somebody has a question, but.
Yeah, all the questions will come in through the Q&A feature.
Okay, so I'll just sort of, pick and choose, although, I mean, if the office want to pick and choose, that's fine with me too, but you're gonna make sure to read them out. Okay.
Okay, and if you guys want to just turn off your video, stop your video and mute until we're ready to start at 9:50. I know it's only a few minutes. We're gonna keep looking for, hopefully the other paper presenter gets reconnected.
Okay. And then we're gonna unmute, and then I will be the one sort of introducing the two at the beginning, correct?
Yep, Joe will actually come on and turn it over to you.
And so I wait until Joe is done and then I turn on my video. Is that the plan?
Sure, yep.
Okay.
Hi, Marnush. It's Jana. Do you want to practice presenting your paper?
Hi, Jana. Sure, definitely. Would you like me to share my screen? And
yeah, sure. Just go ahead and share it one time.
Sure.
There we go.
I just want to make sure that the full screen works here, right? You can see.
Yep, we can see it.
Right, the full screen, and so slides are changing, right?
Yep, slides are changing.
Excellent. Thank you so much.
Oh, sure. And then just make sure you're in gallery view and that you've hidden the non-video participants.
Excellent point. Yes, please.
All right. So go ahead, you can turn your, stop your video and mute your audio, and then Joe will kick us off.
Sure. Thank you very much.
Sure.
Welcome back, everyone. You've heard from the panelists. Now we have a paper session on macroprudential and monetary policy. It will be moderated by Philip Schnabel. Philip is the Martin J. Gruber Professor in Asset Management, Professor of Finance, and Sidney Homer Director of the Solomon Center for the Study of Financial Institutions at NYU Stern School of Business. Welcome, Philip. The floor is yours.
Well, thanks a lot for having me here. It's a pleasure to be part of this session. Let me just briefly introduce the two speakers, and then we'll start with the papers. So first we have Florian Heider. Florian is a senior economist and advisor at the ECB, and he will talk about why so negative, what happens if we have negative interest rates. And our second speaker will be Marnush Shohosini, and she's a professor at the University of San Francisco, and she will talk about the impact of bank stress tests. I remind the presenters they should unmute themselves and share their screens, and we'll start with Florian's paper. So Florian, I see you coming on. The screen is all yours. You have 20 minutes.
Thank you, Philip. And thanks to the organizers for inviting our paper to this conference. It's a great pleasure. So this is a joint work with Christian Bittner at the Bundesbank, Diana Bonfim and Carla Soares at the Bank of Portugal, my colleague Glenn Shapens at the ECB, and Farzad Saidi at Boston University. And these are, of course, our own private views and not the views of our respective employers. We ask in this paper is an old one, which is how does monetary policy and monetary policy rate setting affect bank credit supply? It's an old question, but maybe it's time for some new answers because monetary policy has changed dramatically since the great financial crisis. In particular, rate setting has gotten some attention, not just QE and the other innovations for the unconventional monetary policy. Also, rate setting has become, in some sense, unconventional because several major central banks around the world broke through the zero lower bound. And the views about this are really wide-ranging. It goes from Larry Summers calling it, this is black hole economics, Ben Bernanke being nuanced and saying that the anxiety about negative rates is maybe overdone, all the way to Ken Rogoff, who asks for more negative rates and central banks should invest in environments where they can set unconstrained negative rates. So we just want to know how policy rates then affect the bank credit supply, also in negative rate territory. And there are many answers, but we feel that some of the answers are partial, because we have many different channels through which monetary policy supposedly affect bank bank credit supply. We have the lending channel, we have the capital channel, we have the risk-taking channel, the deposit channel. And what we're trying to do is to see whether we can somehow synthesize some of the insights to examine the recent rate experience in the euro area. And that brings me to my last point, is that we have, in the euro area in particular, we have very good studies for individual countries, but we really haven't gotten really any insights for the euro area as a whole. So what we do is we basically examine the ECB's rate cut in mid-2014, where the policy rate was lowered to negative territory. We examine this in the core and the periphery. And we use 2 credit registers. So we use one in the periphery, so that would be Portugal, and one in the core, that would be Germany. And we also do what we call a comprehensive test of bank lending in reaction to the policy rate change that reflects a little bit these different channels from the previous slide. So we're gonna consider the role of equity and deposits, because both play prominent roles, equity in the bank capital channel and deposits both in the old bank lending channel and also in the recent deposit channel that Philip has actually introduced. And we're gonna examine lending to safe and risky borrowers in order to marry the risk-taking channel and the other channels that look more at the quantity of lending here. So we're looking at the quality and the quantity of the credit supply. So what we find is that in the periphery, where the deposit rates were actually very far away from a zero lower bound, we have that the ECB's rate cut acted like any normal rate cut according to the standard bank capital channel. In the core, so in Germany, where actually the rates were already prior to the rate cut very close to the zero lower bound, the rate cut is less expansionary, and we actually do see some risk taking by some banks. And so what I want you to take away as a message from our paper is that this may be signs of what we call an augmented bank capital channel. And I'll explain exactly what we mean by this. So there's a lot of literature. So there are various people that have looked at how monetary policy has affected credit supply. There's the bank lending channel that was sort of the original one. People then focused on the role of capital because we know that capital matters for bank lending. And as I said, Philip had the pass-through of rates to deposit rates. People in the wake of the great financial crisis have also, some of them I've seen already are in the participants list. So the hypothesis development. So on this slide, essentially, I'm going to recast our view on the bank capital channel. So essentially, we have, and that means that the amount of capital matters for lending, because you need to attract costly funding from outsiders who worry very much about getting the money back. Then the capital must come from somewhere, and the capital comes from banks' net interest margins. So a lower policy rate, according to this logic, increases bank profitability and increases capital via net interest margin, relaxes the financing constraint and allows banks to lend more. In that sense, the rate cut would be accommodative. Why does a lower policy rate increase bank profitability? So I'm introducing some notation because I'm going to use them a little bit for my model later. So we have a policy rate RP. We have a rate on short-term liabilities or short-term debt, RD, and we have a loan rate, capital R. And so the net interest margin increases when the policy rate falls if the pass-through to the cost of funding is stronger than the pass-through to the loan rates. So if the cost of debt falls quicker than the pass-through on the loan rates, the net interest margin expands, banks make more profits and can expand lending. Then you can ask things like in the classic bank capital channel are more financially constrained banks more sensitive to the policy rate change, and less constrained banks less sensitive? Now at the zero lower bound, we need more. Because what we know is that the zero lower bound, there is actually a hard zero lower bound on deposit rates, but not market rates. Short-term rates in the interbank market have gone negative. Rates on government bonds have gone negative. But what has not gone negative is the rate on retail deposits. And so this means that the pass-through on deposit rates of a policy rate is going to be smaller at the zero lower bound than for other forms of bank funding, other forms of short-term debt. And with this, we're going to have that because of the cost of funding falls less for banks that have a lot of deposits, we're going to have less of an increase of all the previous logic, less of an increase of the net interest margin, more capital, and hence less expansion of the credit supply. Even more, we could get slightly perverse effects. We could have a situation where actually the net interest margin falls as the policy rate goes down, not increases, but falls. And that would be the case if the loan rate falls faster than the cost of funding. And this could be the case in particular when you have deposit financed banks. And then we have squeezed banks, and these squeezed banks could be in a situation where they would perform less costly screening of borrowers. And this is our way to think about why these banks take risk. So here's our setting. You see time and you see interest rates on the y-axis, in particular with 3 interest rates. This here down here, the step function, that's the policy rate. That's the ECB's policy rate. It went negative in mid-2014, and that's why we have the vertical line there. And then we have deposit rates in the periphery, here in Portugal, and in the core in Germany. And we see that in Portugal, the rates were very high prior to our rate change. And here in Germany, they were lower. So that means that the rates could come down, like in any normal rate cut, the deposit rates come down. And they could come down more in Portugal than in Germany, because eventually these deposit rates flatten off at 0. We're going to exploit exactly this different in the pass-through. Now, what does it mean? Our previous logic kind of relied a lot on the interest margin. So let's see whether we see this in the interest margin, these different effects in the core and the periphery, and we do. So on the y-axis, we now have the difference between the loan and the deposit spread, the partial derivatives of the previous slides. And what we see that in Portugal, the net interest margin is increasing, and in Germany, it's actually decreasing. So there are different things going on in the core and the periphery. And our goal here is to test for both in one comprehensive framework. So let me just give you a glimpse of the theoretical framework. This is really still work in progress, but I wanted to give you a glimpse of how we think about these things. So to generate the friction, we use basically Holmstrom and Tirol's moral hazard problem. The beauty of that is we can work with a very well, by now I think, understood methodology, which relies on the difference between physical returns and pledgeable returns. So we're going to have an unobservable loan monitoring together with limited liability. That gives you a moral hazard problem. And we have 3 innovations. First, we have that the required rate of outsiders is going to depend on the policy rate. So I can give my money either to the bank, or for example, I could invest in government bonds or other instruments whose return depends on the policy rate. The loan rate also depends directly on the policy rate, say, because there's arbitrage with bond markets or other forms of financing for firms. And then we introduce an ex-ante screening because we want to get at this notion of the risk taking, and we do this with an endogenous success probability P. And with that, we have the usual incentive constraint, whereby if you monitor, you get with probability P the return on each loan, and then you have raised a certain amount of money from outsiders, you lend L and you have own funds A, and on this borrowing, you have to repay a return. And then if you don't monitor, if you shirk, you reduce the success probability, but you get a private benefit. The outsiders are willing to contribute their money. So this is how much they have to contribute. They get repaid with probability P, the RD, and they're willing to contribute as long as this is better than their outside opportunity. And so you can see that the funding volume cancels out, and that's how we get a dependence of the cost of funding to the policy rate via the outside opportunities of outside investors. And then we just do the usual thing. We define the pledgeable return. That's the difference between the physical return and a rent that you have to leave so that there will be monitoring. So B is the private benefit. You combine the incentive and the participation constraint, and then we get at the key external financing constraint, whereby lending is constrained by your own funds, your inside equity, and a multiplier. And this multiplier depends on the policy rate, the screening, and the private benefit. And with this machinery, Where this thing here now depends on these parameters, we can calculate the derivatives that then basically discipline our empirical exercise. We can ask whether the policy rate is accommodative. We can ask whether it's more or less accommodative, whether you have more or less private benefits, because that would mean your constraint is more or less binding. Or we could also say, is, well, how does the probability of screening depend on the policy rate? But that's it for the theory, because I only have very few minutes. So let me go into the data and the empirical specification. So the data, all I will say is here that we use 2 credit registers from the Bank of Portugal and the Bundesbank, and we cannot combine them. So we run the same set of regressions separately in Frankfurt and in Lisbon. It was prior to Corona. We did quite a bit of traveling. And then we compare. So we cannot really merge these data sets. The way we tackle the question empirically, our empirical specification is a standard diff and diff. We have information of credit from a bank to a firm at any moment of time. Our left-hand side variable is some measure of lending. So our main variable is actually a new relationship. I'm gonna tell you in a second what this means. And then we have the standard diff and diff approach where we have bank fixed effect. So everything is within bank. And then there's a time fixed effect. So everything is also within time. And then you ask, are banks that are more exposed to the policy shock, so after mid-2014, are they lending differently than the control group, which would be banks that are less exposed to the monetary policy shock? So making one thing more precise is that the time fixed effect is actually at the firm level. So we're differencing everything away that happens through time at the firms. So that would be, for example, demand. We want to control for demand, to be able to talk about credit supply. But it also means that any differences between the economy of Portugal and Germany is also going to be differenced away at the firm level. So what we need to check still is whether the banks are comparable. And I'll do that in a second. Then the left-hand side variable is the extensive margin. A lot of people look at the intensive margin, but we think, and we have it as well in our paper, but we think that the extensive margin is where all the action is, or a lot of the action is. So extensive margin in this type would be if your stock of credit between a bank and a firm shows up as non-zero, whereas before it was 0. That's essentially then coded as 1, and this is the variable I'm going to show you results for today. But we have other definitions. And then the exposure is either the equity to asset ratio or the deposit to asset ratio, because that's sort of the standard bank capital, and this would be the augmented bank capital channel. So it is important that our banks are comparable, and the summary statistics show you that they are somewhat comparable. So we have an equity ratio of 9.5% in Portugal, of 6% in Germany, and a deposit to asset ratio of 32% and 37%. So 32 in Portugal, 37 in Germany. So they're broadly comparable. Difference across firms are going to be differenced away. So the credit supply. So this is our sort of main empirical exercise. So let me take you through it. Our comprehensive test consists of this sort of 2x2 matrix. So on the left-hand side, we have the extensive margin, and then we have Portugal and Germany, and we have equity as the exposure variable, and then we have deposit ratio as the exposure variable. And we have either the lending to all firms in Portugal and Germany, or just to the riskier or safer ones within the firm distribution in each country. What do we get? We get that away from the 0 lower bound, the standard bank capital channel is at play. The standard bank capital channel says that a bank that has a lower equity ratio should be more sensitive to the policy change. That's why we have a negative coefficient. So a lower policy rate, more lending to all firms, no risk taking. There is no difference between lending to risky and safe. In Germany, the equity channel is not present because we're actually at the 0 lower bound. The interest margins presumably are already compressed, so there's no much effect there. In Portugal, we're away from the 0 lower bound. So the bank funding structure doesn't matter. The deposit ratio doesn't show up significantly. But in Germany, the deposit ratio matters. So banks that have more deposits, that are more squeezed because there's less pass-through to the cost of funding, they lend to risky and risky only. So that's what we mean by an augmented bank capital channel, is that within the same framework of thinking, we can explain the coefficient here that depends on the equity, and here the lending to risky banks that depends on the deposit ratio, and also the absence of effects of the diagonal, if you want. So the real effects, unfortunately, I have to jump over. We have a little bit of an innovation because we're testing for the extensive margin. I want to go through the implications for the euro area quickly. So what we can do is we have sort of a country from the periphery and the one country from the core. So even though we don't have access to the credit registers of other euro area countries, we know how much pass-through deposit rates there was. So we can use this to look at every other country as a convex combination. So let me do this very quickly. So in the bank capital channel, Portugal is our benchmark. So everything is benchmarked against Portugal. We're looking at a 10% change in the equity capital. So this is actually our coefficient times 10 from the previous table. That was the 0.03. That's the 0.3 here. And then every other country, we have the pass-through, let's say, of the deposit rates in Italy. That's only a fraction of the pass-through in Portugal. So the coefficient here is the respective fraction of the coefficient for Portugal. So what I want you to take away is how the bank capital channel fades away the closer you are at the zero lower bound. Similarly, for the opposite effect, for the risk taking, our benchmark was Germany. This 0.29 is 10 times the coefficient in the table because we're now looking at a 10 percentage point increase in the deposit ratio. And then let's say another country like Portugal, where we saw that there was a lot of, they were far away from the zero lower bound. So there is not this closeness to the zero lower bound. So the effect there works less. And again, we have sort of now it's a fading in of the deposit channel, the closer you are at the zero lower bound. And with that, I have my conclusion is that we hope that we have shown that there is a way to look at post-crisis monetary policy rate transmission in a comprehensive way. We have one framework that would be an augmented bank capital channel. What matters in there is the external financing constraint, the net interest margin, but also the funding structure. It matters whether you fund yourself with deposits or with wholesale debt. And then for the euro area, there are strong differences in the transmission. There's stimulus in the periphery from our going negative, because there it works like a normal rate cut, but there's risk taking at the core because these high deposit banks find it too costly to screen borrowers. Thank you very much.
Thanks a lot, Florian, for a very clear presentation. I will now hand over the screen to Manoush. I think, Manoush, if you can just turn on your video and unmute yourself. Excellent, I see you there.
Thank you.
Please, just share your slides and the screen is all yours.
All right, thank you very much. Thank you for including this paper into the program. And it's such a great pleasure to be here today and present this work. And I really appreciate any comments and feedback. So the systematic risk of the financial system are the major focus of a macroprudential supervision. By contrast, a microprudential approach to financial regulation examines insolvency of individual financial institutions regardless of the spillover effect in the economy. After the Great Recession of 2008, regulatory reforms moved in a macroprudential direction to prevent fire sales and credit crunches. So a new bank examination known as stress tests represent one of the most important regulatory responses to the 2008 financial crisis, linking the micro and macroprudential supervisions. A stress test requires a subset of banks to have higher regulatory capital ratios to absorb losses and mitigate any type of moral hazard problems in the market. However, how banks meet higher capital requirements, whether through raising fresh capital or shrinking assets, determine the financial stability of the economy. So in this paper, I examine how banks respond to the higher regulatory capital requirements of stress tests and adjust their capital and lending actions to pass those tests. I also analyze how these bank liquidity shocks transmit to the real side of the economy. So banks can meet higher capital requirements in 3 different ways. So imagine the current capital ratio of a bank is about 10%, and it is required to increase their capital ratio to 20%. So they have 3 different ways in order to meet the regulatory capital requirements. They can recapitalize their balance sheet by issuing equity and repurchasing debt while keeping assets unchanged. Alternatively, banks may issue new equity to expand their assets, or they may sell assets to buy back existing debt. So they have, in general, they have 3 different ways in order to meet the regulatory capital requirements, and that has been discussed theoretically by Annette Admety and DiMarzo's paper. So in both recapitalization and asset expansion mechanisms, banks increase capital ratio by issuing equity. And banks have discretion to decide whether to increase capital ratios by equity issuance or asset sales. Put it differently, banks may raise the numerator of capital ratio through issuing equity or decrease the denominator by selling assets. But whether banks acquire or sell high versus low quality type of assets, that would impact the systematic risk in the economy. And banks' strategy may also affect financial decisions of borrowing firms through the lending channel. So in order to test my hypothesis and to see the impact of stress tests on the real economy, I have 2 main empirical challenges. Historically, capital requirements rarely change over time, and typically all banks must comply with those requirements at the same time. So that makes it very difficult to find a subset of banks that must comply with higher capital ratios. So to address this issue, I use the US Federal Reserve selection rule in choosing banks that went through the stress testing after 2008 financial crisis. It is also important to determine how banks' capital transmit to the real economy, and I also want to make sure to eliminate the impact of demand channel and just focus on credit supply. So to control the credit demand, I compare the same firm borrowing from 2 different types of banks, and the only difference between those banks are related to their eligibility for stress test. So I use multiple bank firm relationships in syndicated loan markets to control for credit demand and basically disentangle supply side from the demand channel. So the summary of main findings, this paper shows that in response to the regulatory reform, stress tested banks increased their total capital ratio by 11% compared to the non-tested group. And in order to achieve this goal, they increased both the numerator as well as the denominator of their capital ratio. In particular, the numerator, the total capital exceeds the denominator, the risk-weighted assets. And these banks achieve these targets by issuing equity in order to expand their assets and reduce their leverage in a form of asset expansion and recapitalization. I also investigate the analysis at the loan level, and I found that stress-tested banks originate new syndicated loans more than the non-tested group by 29 percentage points. At the extensive margin, these banks keep lending to existing borrowers as well as start lending to new ones while excluding the small borrowers. As we know, stress tests connect capital to loan portfolio of these banks and that induce banks to rebalance their loan portfolio towards safer lendings. So basically, stress-tested banks increase lending to large and safer borrowers while reducing credit supply to small and riskier firms by 28 percentage points relative to the large ones. So overall, higher regulatory capital requirements influence banks to incorporate borrowers' risk in designing their loan contracts and basically adopting a stricter measures towards small and riskier borrowers who usually violate more covenants. And finally, the transmission of bank credit supply to the real economy depends on whether borrowers mitigate the credit loss by borrowing from all the other available lenders in the market. So in particular, if borrowers cannot smooth out the liquidity shock and the liquidity shortages that have an adverse effect on the economy. So the results show that higher regulatory requirements change the lending behavior of banks and harms dependent borrowers who cannot find alternative sources of external financing. So overall, firms dependent on borrowing from stress-tested banks, they could not compensate the bank credit loss by borrowing from alternative lenders. And as a result, they reduced their assets and investment by 26 and 28 percentage points, respectively. So a little bit of institutional background related to stress tests. The 2008 recession highlighted critical deficiencies in the risk management practices and resiliency of financial institutions. On October 2008, US regulators devised the Supervisory Capital Assessment Program known as SCAP in order to determine the vulnerability of financial institutions. And this regulation requires a subset of banks to have at least 6% of Tier 1 capital ratio and 4% of Tier 1 common capital ratio by the end of 2010. So policymakers conducted the stress test regularly since then through CCAR and Dodd-Frank stress test. And the main objective of stress test is to ensure that banks have enough capital to continue lending even in adverse economic conditions. Unlike regular banking examination, stress tests are simultaneous and forward-looking assessments of banks' capital under different type of scenarios. And these tests are unusually transparent in inputs, process, as well as outputs, and banks require to disclose their results to the public. So I use the Federal Reserve's criterion that selects a subset of banks to include in a stress test based on a determined asset threshold of $100 billion in the last quarter of 2008. The main data sets that I have used here is from the Federal Reserve Y9C, the quarterly reportings of bank holding companies. And I have also used DLScan on syndicated loan, as well as Compustat and Bloomberg quarterly data. And I have merged all these data together. So as an identification strategy, I compare banks before and after the policy change in 2008 Q4 using a diff and diff matching model. So the cross-sectional variation of banks allow me to show the causal impact of higher capital requirements on banks' credit supply. And I created a matching sample based on the control group who are banks with assets above $20 billion and below $100 billion in the last quarter of 2008. So I used the matching method, nearest neighborhood matching method of Abadi and Emmons in order to construct a matching sample. So looking at the pre-treatment median test of banks, here I want to make sure that stress tested banks and the matched control group are comparable prior to the test. So I looked at the total regulatory capital ratios consist of both Tier 1 and Tier 2 capital adjusted by risk-weighted assets to create this capital ratio. And here, as you can see, using the median test, the stress tested banks and the control groups, those are comparable prior to the test, meaning that there are minimum differences between those two, especially the matching technique improves the quality of the sample here. I also looked at the trend of Tier 1 capital ratio as well as total capital ratio, just to make sure that the diff in diff model is a valid test here. And looking at the point estimates on Tier 1 capital ratio, here I include the interaction term between each quarter and stress tested banks. And looking at those point estimates, as you can see here on the top panel on the left, there are less differences between those banks prior to the test. So the blue vertical line shows the 2008, the last quarter of 2008. And you can see prior to the test, there are less differences between these banks, and suddenly the Tier 1 capital ratio between those banks have become significant. I also looked at the parallel trend assumption here, and just to make sure that these banks are comparable prior to the test, I looked at the numerator of capital ratio, Tier 1 capital, as well as the Tier 1 common equity. As you can see, the differences started to expand right after the announcements of those tests. I looked at the adjustments of banks' behavior. So mostly here, I put all the hypotheses into a formal regression. And the results of diff and diff model here shows that a stress-tested bank increased their capital ratio as well as increasing their equity in order to meet the test requirements. Here I include bank fixed effect as well as time fixed effect in order to make sure that I capture the unobservable differences between those banks as well. So overall, banks increase their capital ratio in order to meet the stress test requirement. And here they achieve that by expanding their equity side as well as lowering down their leverage in a form of asset expansion and recapitalization. I also looked at some of the risk components here. Stress-tested banks, overall, they become more conservative relative to the non-tested match group, and they report more non-performing loans as well as loan loss reserves. They also increase the commercial and industrial loan ratio here after the test. Later on, I focus more on the loan level analysis. So here I capture the same firm borrowing from two different types of banks and make sure that, just follow those firms before and after stress test. And here, as you can see, the new loan origination has increased, and I captured the credit supply using the intensive margin sample. So the new loan origination has increased after the test announcement, as well as the loan spread as a pricing for those loans. So that has been shown on the top panel here. And in the lower panel, I'm focusing more on the same firm borrowing from two different banks. So here I have used the fixed effect, and as I expected, the graphs are more of a mirror shape as I expected here. So putting that into some numbers and in a form of estimation, here we can see that stress-tested banks increase new loan origination by 29 percentage points while reducing credit supply to small borrowers, and that comes in the form of line of credit. They have also increased the spread and reducing spread for small borrowers. I have also used a regression discontinuity around $100 million asset threshold. This is the result of that regression. Again, stress-tested bank increased loan origination as well as a spread. I have also looked at the covenants and maturity. So overall, tested banks have set lower number of covenants, and they have offered longer maturity compared to the non-tested group. But those are the results are different for small borrowers. So stress-tested banks have become stricter towards small borrowers by setting higher covenants and also requiring shorter maturity for those firms. At the extensive margin, I want to test whether stress-tested banks keep lending to existing borrowers or start lending to new borrowers. So here I found out that stress-tested banks are 9 percentage points more likely than non-tested group to maintain lending to existing borrowers, as well as start lending to new borrowers by 21 percentage points. So I find results both at intensive margin as well as extensive margin here. Looking at the pricing and non-pricing attributes, here I find out that small firms are the one who usually violate more covenants, and as a result of that, stress-tested banks are becoming much stricter towards small borrowers. I also looked at borrowers' heterogeneity, keeping in mind that borrowers are different. So stress-tested banks, again, they increase credit supply to large, safer borrowers, and they reduce credit supply to small, riskier borrowers. So here I looked at speculative grade borrowers who have less originations going towards them. And also I measured the riskiness of these borrowers using the Z-score measure as a measure of bankruptcy risk. So small firms are at the bottom of 70% of total borrowings across all banks in each quarter. And as you can see, stress-tested banks have become stricter towards those small borrowers by demanding more covenants and shorter maturity on their loan contracts. So the impact of the credit supply on the real side of the economy depends on how dependent borrowers would compensate the bank credit loss, especially those small borrowers who have been depending on liquidity from these banks. So the reduction in credit supply of stress-tested banks may not necessarily impact the economy at the firm level if those firms are able to find alternative sources of financing. So for that reason, I created a new measure known as a borrowing share in order to measure the dependency of these firms on liquidity and borrowing from stress-tested banks. So here you can see that here I'm focusing more on the demand channel, just to see that dependent firms on borrowing from stress-tested banks prior to the test, they cannot compensate the liquidity loss by borrowing from new banks. And as a result of that, I can see that the firm financial outcomes have been negatively impacted. So those small dependent firms, they have cut back their assets and investments by significant large numbers of 26 percentage points and 28 percentage points respectively. And that's because they could not find any alternative sources of financing. So overall, I created also a matching group here, just focusing on higher dependent borrowers versus lower dependent borrowers on stress-tested banks. And the results of matching shows that these firms and these borrowers are comparable prior to the test. And then I performed this estimation on firm financial outcomes to measure the impact on the real side of the economy. So the credit supply shock started from the banking system, has a negative impact on the asset side and investment of dependent firms who are mostly relying on stress-tested banks. So to conclude, stress-tested banks increase capital ratios and lending compared to the non-tested group. They increase lending to large borrowers while reducing credit supply to small borrowers. So here I disentangle the credit demands from the supply side. I have also included the firm quarter fixed effect in order to control any time varying demand channel differences, and the result is robust using firm quarter fixed effect. So firms reliant on borrowing from stress-tested banks significantly reduce assets and investment compared to the less dependent borrowers. I have also tested the medium-sized bank as part of the Dodd-Frank Act 2014, and I found that similar results to the large banks in capital adjustments and lending behavior. As for policy implication, from a macroprudential perspective, it is very reasonable for regulators to require higher common equity to ensure the quality of banks' capital, as suggested by Hansen in 2011. And the results of the US bank stress test can guide policymakers to evaluate higher capital requirements, especially under the Basel III process, and also the expansion of the shadow banking system after the financial crisis. Thank you very much, and I would appreciate any comments and feedback here.
Okay, excellent. Thanks a lot for a wonderful presentation. So the remainder of our session is I will have a discussion. I have 15 minutes, and then what we'll do is, answer a few questions. So if you have questions, please, put them into the Q&A, and we'll try to get to some at the end of this session. So I should say, and I hope you can see my screen now, I really appreciate reading both of these papers, and right at the outset, I should say I suggest you go and read them yourself, because they're very nice papers. I'm not going to do them justice in just 15 minutes. So what I want to do is just give you a brief overview of each paper. I have one main comment on each paper, but it is just very little time, so I definitely recommend these papers to all the audience. So what's the common theme of these papers? It's about the supply of credit. That's what both papers are looking at. That fits nicely with the theme of the conference. It's not a surprise to this audience that the supply of credit is important for economic growth and investment. And we know if there's a crisis in the financial system, if there's a financial crisis, that leads to a decline in the loan supply and causes deeper recessions. I think the work of Reinhard and Rogoff has shown this nicely across countries and over time. And obviously, the 2008 financial crisis was a stark reminder of that. Now, the papers differ a bit on what they emphasize in terms of the determinants of lending. The paper one focuses a bit more on deposits. The paper two focuses more on bank capital. So just sort of think about the role of deposits. Well, we know deposits are special for long-term lending. Why are they special? There are a number of reasons, which are not mutually exclusive. So Jeremy Stein has a nice paper where he argues it's about the fact that the adverse selection discounts if you issue wholesale funding. There's a paper by Hansen et al., which shows that deposit, in particular retail deposits, are less run-prone, so they represent stable funding. And I have some work forthcoming to Journal of Finance where we argue that deposit franchise value is actually a very good hedge for holding long-term assets, so they're a way to manage interest rate risk, and they're therefore good for long-term lending. The second paper focuses on the role of bank capital in lending. We know that banks may have a tendency to have too little capital, even though they need it in order to take on risk. Again, a number of models sort of looking at that. A famous one is Diamond and Rajan, who argue if there's too much capital, banks may not monitor well. There's the issue of explicit and implicit government insurance. Florian actually has an earlier paper sort of looking at this empirically. There's also the issue of tax. So Glenn Chapman actually has a nice paper sort of showing that the tax treatment actually favors debt over equity. So let me just start by discussing paper number one and think about the role of deposits. As Florian mentioned, this sort of builds on the deposit channel of monetary policy. Not surprisingly, that's a topic close to my heart because the title of a paper I've written with Itamar Drexler and Alexei Savov, which was published in the QG in 2017. And just to give you the gist of it, the idea is that if you have a higher normal interest rate, there's a higher price of deposits. And we think of the price of deposits as the deposit spread. So the difference between a short-term nominal rate, like the Fed funds rate in the US, minus the deposit rate. And that's coming endogenously because basically the nominal interest rate sets the price of the outside option, namely cash or currency. And if that option is particularly unattractive because interest rates are high, well, then banks have market power and they exploit it basically by increasing the spread. And a nice way to see that in the time series is what I'm plotting here, and that's updated to 2020. You kind of see that whenever the nominal interest rate is high, that's the Fed funds rate in blue, that the deposit rate is lower. So the spread between the two opens up. Now, why do you care about the price of deposits? Well, because the price affects the quantities. And that's here now my second picture. Again, that's from my QG paper updated to 2020. What you see is that, here's the year-on-year savings deposits growth plotted against the year-on-year change in the Fed funds rate. And you see the stark negative correlations. So anytime the Fed funds rate goes up, meaning monetary policy tightens, deposits flow out of the banking system, and vice versa. If monetary policy loosens, if you lower the rate, deposits flow into the banking system. So if you have a higher nominal rate, the outflows of deposits, less lending, and that channel works in reverse when you lower the rate. Now, what happens if you have negative interest rates? So a number of countries, not the US, but a number of European countries, also the Bank of Japan, have moved towards negative interest rates. I'm just plotting a number of them here. The one we are focusing on is the European Central Bank. You can see in 2014, they moved the deposit facility rate into negative territory. And that's kind of the period we are looking at here. Now, Florian actually has an earlier paper together with two co-authors on this paper where they sort of point out the problem you run into, namely the zero lower bound, and the fact that deposit rates are stuck at zero. So this is actually a figure from the earlier paper. And the dotted line shows you that bank deposit rates are stuck at zero, even though the ECB deposit facility rate turns negative and sort of market rates like the 3-month Euribor also turn negative. And so what that means is this deposit channel is impaired. So you don't get any deposit inflows, and so there is no effect on lending. There's no increase in lending as you lower rates into negative territory if deposit rates are stuck. And that just means monetary policy becomes less effective or ineffective at the zero lower bound, and that has motivated a number of theoretical papers. So, Brunemeyer and Colby called it the reversal rate. My colleague at NYU, Olivier Wang, also has a very nice paper on this and also comes to a similar conclusion. So what's new in this paper is to do this very nice comparison of looking at a country in the core, namely Germany, and a country in the periphery, namely Portugal, and to collect all this wonderful data in order to do this very carefully. The starting point is the fact that the deposit rate in Portugal was higher than in Germany at the time. So you've seen this picture already. So the intuition is that the deposit channel should work better in Portugal than in Germany. The only thing is I'd like them to comment a bit more on why they were high in Portugal. You see that eventually they converge in 2018. And I was just wondering, what you want are the marginal rates, but I think what we're plotting are the average rates. And that can be an issue if they're more time depositing Portugal. It just takes longer for changing deposit rate to show up in the effective deposit rate being paid. So I don't think that's the case, but I think it would help to clarify and give a little bit more context of why we started off with a high deposit rate in Portugal. Now, I pulled out some of the results from tables 2 and 3. Those are the key tables. So as Florian explained, to look at new lending relationships on the extensive margin, Portugal versus Germany. And they're going to look across banks depending on the deposit ratio that follows on the earlier work. And they put in this firm fixed effects, which is wonderful because the idea is they can control for any kind of changes in credit demand at the firm level. So just compare two different lenders lending to the same firm. Now, one thing I would like them to do is to just sort of compare and reconcile these estimates to the previous work. So the previous work to look across banks, and I think the next step is sort of to looking across loans. And then once you look at across loans, you might want to look within firms across loans. And so I kind of like to see each of these steps to see whether these coefficients are robust or how they change as you sort of look at these different samples. The other thing is I'd like to comment a little bit more on the difference between Portugal and Germany. I'd like the office to do that. So I didn't look so much at the risky loans, but if you just look at all lending, my expectation would have been that Germany actually is negative, maybe even more negative. So you see the substitution to risky loans, so that's very interesting. But I like to also see sort of the effect on average lending, and I think if they could comment more on this, that would be useful. Now, result number 2 is this bank capital channel. So it's the same kind of regression, but instead of putting the deposit ratio on the right-hand side, they put the capital ratio interacted with this after dummy, after the ECB lowered interest rates. That's on the right-hand side. And they find this sort of marginally significant effects for Portugal. For Germany, the coefficients are actually similar, the point coefficients, but they're not significant, maybe because the sample is somewhat lower there. Again, they do this nice firm fixed effect so they can look within firms. So the interpretation is the bank capital channel. And the intuition there is that, you lower these interest rates because banks have long-term loans, while the value of those is going to go up. And so that's going to help bank equity values. And so the weakly capitalized banks are going to benefit more. That's why you have a negative coefficient on the capital ratio. That sort of complements the intuition which Florian laid out in his model. But a main comment is, I'm not 100% sure we can just disconnect it from the deposit franchise value. So let me explain what I mean is, when you hit the zero lower bound, as I showed you before, you're not going to earn any deposit spreads. And deposit franchise value is sort of the forward-looking, the discounted value of this deposit spreads minus the cost of providing deposits. So if you think you're going to be at the zero lower bound for a long time, this deposit, the franchise values get impaired. And so if you think about banks ex ante, think about the capital structure, if they avoid getting particularly impaired at the zero lower bound, they may sort of have a higher capital ratio ex ante. So that may correlate with this capital ratio here, and it actually may pick up the effects of deposit franchise value. So this is not so much about identification, it's more about interpretation, but I think I would like the authors to think about that and maybe comment on, to what extent you can disentangle the effect of capital versus deposits. Okay, so that's what I have on the first paper. Let me move to the second paper. The second paper is of the impact of bank stress tests. What the paper really does, it compares banks that undergo stress tests versus banks which do not, so the ones which just below these cutoffs. And it looks at a number of outcomes, bank capital, particularly capital ratio, but also the amount of capital being raised. It looks at lending, and it focuses on the syndicated loan market. And the idea is it can do also what the previous paper has done. It can look within firms across loans. And the benefit of doing that is, again, you can control for changes in credit demand. And then the last thing is to look at the access to credit. So, what does that mean if you're exposed to a stress test bank? Does it mean you have less access to credit? And if so, can you substitute by borrowing elsewhere? And what are the real effects? Now, the identification assumption here is, as always, you kind of need the parallel trends for large versus, I would call them mid-sized banks, the ones who just didn't do the stress test in the absence of the bank stress test. It would have sort of evolved parallel. Now, I should say in this context, and I think this is a hard question, but this is a strong assumption because obviously there were other things going on which may have affected large versus mid-sized banks differentially. So one issue is obviously that we think, some of the banks may have experienced, a loss of explicit government guarantees. That's a too big to fail problem. That may affect large banks more so than smaller banks, and therefore, incentivize them to raise more capital. Also, large banks, I think, really realized that the risk management made some serious failures and just may have adjusted on that because they learned about it. And then the Dodd-Frank regulatory framework is obviously bigger than the stress test. The stress test is a very important part, maybe the main part. But I remember at NYU, our faculty, we wrote a book about Dodd-Frank at the time, and I believe we had like 27 chapters. So there are obviously other things which will affect lending as well. So the way I'd like to identify this treatment effect is a little bit broader beyond the stress tests. So I want you to keep in mind that other things were going on at the same time. Now, looking at the results, you've seen this figure. So first of all, it's clear that the large banks, the stress test banks, increased the capital ratio. And importantly, as Manoush pointed out, that's not obvious ex ante. So it's nice of her to show that they actually increased the amount of capital. So they really raised a lot of capital. They didn't just substitute it for some debt or decrease the asset side. Now, here I'm pulling out what I think are the main results at the loan level. She looked at the syndicated loans. And there's sort of this interesting effect where you have positive coefficients. So on the intensive margin, you see that the banks which were treated, the ones which actually increased their lending. But then if you do this triple interaction, you see that in column 2, with small firms, that doesn't really apply to the small firms. If you look at the extensive margins, this is exit, so you should sort of interpret the coefficient as sort of being positive. You again find that the stress test banks, increase their lending, but there's no differential effect, at least no statistically significant effect on the small banks. I think I'd like, maybe the paper to comment a little bit more why we think the small firms are particularly affected the intensive margin with the extensive margin. My expectation would have been different because the banks already know the firms which they're dealing with on the intensive margin. So I think some comment on that would be helpful. Then the next stage is Manoush takes it to looking at total access to credit, and she finds that basically some firms get shut out from these credit markets. The bank-dependent firms, they can't get credit elsewhere, and so she sees this real effect. And this figure is showing one of those. You see those less fixed assets, less fixed asset growth. I think it would be helpful, given that on net we actually see the large banks increasing their lending, to think about what are the aggregate effects. I'd like to see this picture not just for the average bank. I would like to see value weighted by the size of the firm, because I think this must be driven by the small banks. And so if we aggregate up because the large banks are larger, I think it would be interesting to sort of explain whether that holds for the larger firms or not. And now let me get to sort of my one main comment on this paper. The other thing I'd like her to do is sort of reconcile it with results she has early in the paper. So early in the paper, she says that the stress banks actually increased the assets a lot. You see that they increased the capital a lot, but also the assets. The total assets of the banks subject to the bank stress test increased by 34%. And that's not just safe asset, because you also see it with risk-weighted assets. So what that means is the stress test did, increase the asset size a lot, but not in syndicated loans to small firms. But I wonder whether there were other ways how they potentially were supporting lending to small firms. So there would be other forms of C&I lending, which are not syndicated loans, where they may lend to small firms. They may buy securitized assets, which, support potentially SME securitization. So that's a way for them to provide funding. And they may lend to non-banks. I have some work where if you look at the small firms, small business lending is the non-banks, finance companies and fintech lenders increased a lot during this time period, and some of their funding came from banks. I just want to make sure in some sense that the banks didn't support that market in other way, and sort of think about that relative to her main result. So summary, as I said in the beginning, these are two great papers. I recommend reading both of them. I didn't really have enough time to cover a lot of the interesting results in them. If I had to summarize, what's the key message? Well, paper 1, I say, authors think beware of the zero lower bound. Retail depositors do not play along. And so, bank lending is impaired and monetary policy becomes ineffective. And paper number 2, I think that the main message, regulation increase the resilience of the financial system, but we really have to be careful we don't penalize the lending to small firms. Okay, these were my comments, and I think we have a little bit of time for questions, and I see one question popping up in the chat. So I'll just read it out, and I will let the office take this. So the question comes from Jose Perospida, and he says, for the second paper, are there differences in credit supply between banks that passed and those that did not pass the stress test? Is the conclusion that stress tests have caused adverse real effects on smaller bank-dependent firms, even if they may be credit-worthy? So I'll let Manoush answer this right now.
Sure. Thank you so much, Philip. Thank you very much for all the comments that you have made, all well taken. And that's a great question, Jose. So I did not look at the banks who passed the test versus the one who did not. And the majority of the banks who have taken the earlier round of stress tests, they passed the test, but I did not look at that heterogeneity across banks. As for your second question, yes, the message of the paper is it improves the resiliency of the financial system overall. Stress tests and having higher capital requirements improve the financial system in general, especially in terms of financial stability. But we should be also careful about those small dependent firms who cannot find alternative lenders, and maybe those are credit worthy, and we should take care of them in alternative ways, maybe providing some stimulus packages or some other type of lending, alternative lending to them.
Excellent, thank you. I don't see any other questions in the chat. I think I want to just give Florian an opportunity, maybe 1 minute or so, if he just wants to conclude or make any final remarks on this paper, and I think we'll finish after that.
Okay. Thanks, Philip, so much for really insightful comments. Very, very helpful. And I think you're spot on all of them. We need to understand why the deposit rates were high in Portugal and low in Germany. And actually, I didn't have time to show. And we're aware there are different types of deposits, and so we're looking into those. But the main reason is the government bond yields. Actually, we think that here the sovereign bank nexus is doing us a favor, because Portugal was risky, government bond risk yields were high. These are alternative for depositors, or they are on banks' balance sheets. So in any ways, there's a very tight link between the government bond yields and deposit rates, actually. And it's in the paper, didn't make it into the presentation, but is right at the end, and we need to do more on that, because that gives us the variation, the data that we're then exploiting. Yeah, absolutely. I think, linking it to our previous work would be super useful. Just to be clear, our previous work used syndicated loans. We didn't have access to credit register data at that point. So we used syndicated loans, and that amounts to about, at most, something like 8 or 9% of the activity that banks are doing. So that's in many ways why we wrote the second paper, because people were kind of saying, it's not really, that's only a sub-market, what's happening in the real economy. So that's why we then went into the more painful task of looking at credit registers, but we'll do that. And the last thing, actually, we actually want to reconcile the deposits and the equity in some form or another. So it's exactly how you're thinking. That's why the model will be quite helpful, because of course, you don't care so much about the inflows you don't care so much about the deposit franchise if your overall franchise value is down in some sense. That would be maybe one way to link these, right? The equity gives you, or the financing constraint gives you overall franchise value. And then you can see where this value comes from it. And on the funding side, it comes from the deposit franchise, and these interact. And that's what we're trying to do here. So we'll definitely push that line further, and hopefully the model will help a little bit along the way. So we don't see this as two separate. We see this as interacting different ways in different parts of the euro area under different economic conditions. Thanks.
Okay, excellent. Thanks a lot. So just a big thank you to the presenters, and I will hand it back to the organizers. I think we're going to break. So I think Joe is coming on. So thank you for having me, Joe.
All right. Thank you to Florian and Manoush for excellent papers, and Philip for a very insightful discussion. We'll now have a short break as we move the next session participants over to present. see you all back here at 11 o'clock for the next panel session. See you soon.
Hi, Amy.
Hi, Amy.
Hello.
So we just want to make sure that you have your set to gallery view on your screen so you can see everyone on the panel, and that you hide the non-video participants.
Yes, so I'm in gallery view. Let me hide the non-panel participants or non-video participants. Got it.
And then I know you're the moderator of the session. Are you going to share your screen at all?
No, I am not.
Okay. And hi, Daryl, are you going to be sharing your screen at all? And you're on mute, just so you know.
Yeah, thanks, Jana. No, we're just making verbal remarks.
Okay, just make sure, again, if you didn't hear the directions to Amy, just make sure you're in gallery view and that you've hidden your non-video participants. This will allow you to see everyone on the panel and also allow you to see the timekeeper. Hi, Isabel, we can hear you and see you.
Hello. Actually, I can take off my mask now. So I will have slides, okay?
That's okay. You do not, correct?
I do have slides.
Oh, you do? Okay.
Yes.
Why don't you share your screen? And
okay, so let's try.
Yep.
Jana, how do I hide my non-panelist participants?
Okay, do you see a bunch of black boxes with names in them?
Not anymore because something else has happened. Okay, here we go.
So can you see my slides? Just so that I can go back.
Yep, we can see your slides.
Excellent. Thank you.
I have slides also.
Okay.
Can you
go ahead and hit, yep, stop sharing. Perfect. All right. So, and again, make sure you've hidden your non-video participants. So Daryl, on your screen, do you see a bunch of black boxes with names?
I do.
Okay, so go into one of the black boxes and there's 3 little dots in the right-hand corner of that screen. Yeah. And you can just hide the non-video participants once the sharing's finished.
Do you see my slide?
Yes, we can see your slide.
Now, how come I don't think I can see it. Am I supposed to be able to see it?
No, if you're sharing your screen, so you should see what's on your screen.
Are the slides changing now?
Yes.
And are you on 2 computers, on 2 screens? Because you might have your slides on the other screen. That sometimes happens if you're on.
Yeah, I have three screens. Maybe that's why. Okay, let me, I have to undo it, right?
Yep, stop sharing at the top of the screen.
There we go.
Perfect.
Janet, as others are sharing slides, I might show 1 or 2.
Okay. Do you want to try sharing your screen?
Yep, I'll do that right now. How's that? And I can go to full screen as well.
Yep.
Okay.
Perfect. Yep.
I'll start sharing now.
Yep, we can see it. All right, so just as a reminder, everyone on gallery view, and hide your non-video participants. That way you'll see everyone on the panel, as well as the timekeeper screen will pop up. And the timekeeper is timekeeping the entire 60 minutes. So you will not be individually timekeep during your initial remarks.
How do we hide? I don't think I have any non-screen participants.
If you don't see any black boxes with names, you're good.
And how do you go into that mode of
gallery view?
Yeah.
So in the top right corner of your screen, there should be it should say view, or it'll say speaker view or gallery view in the right-hand corner. Do you see that?
Got it.
Okay.
Do we have Viral here?
I'm here. Oh, Viral. Yeah, he's not here yet.
Before we go in, can I just say everybody's name real quickly, just to make sure that I'm pronouncing everyone's name correctly? Daryl's easy. Daryl Duffy. Viral Acharya. He's not here yet. So Isabel Schnabel.
Perfect.
Ben, is it Golub?
Golub.
Golub, okay. And Antoinette Shore.
Perfect.
All right, thank you.
Okay, mute me again.
All right. I don't see Viral yet, but I don't want to delay things very much. So let's see if he ends up joining us. So Amy, you might have to do a little soft shoe or something, or maybe give people more chance to get questions from the audience.
Yeah, we can skip over his opening remarks until he gets there. He's not the first speaker, so he has a little bit of time.
Great, great. Welcome back, everyone. We have a large number of distinguished people for our second panel, which is Financial Market Frictions and Liquidity. It will be moderated by Amy Edwards. Amy's the Assistant Director of the Office of Markets for the U.S. Securities and Exchange Commission. Welcome, Amy. Please unmute and start your video.
All right, thank you. Before I talk, I do have to give a disclaimer that anything I say represents my own views and not the views of the commission, the commissioners, or other staff at the commission. But I will be moderating, so my opinions will be very minimal. So we do have a distinguished panel here today to talk about market frictions and liquidity. A lot of the discussion will be focused on COVID-19 and how the markets managed the crisis last March. This provides an opportunity to view these market frictions and see how the markets reacted and how they handled the stress. So we have 5 panelists today who are very distinguished panelists, and I will introduce them each, and they'll give a 5-minute opening remarks. Afterwards, we will cover several other questions. At any point in time in this session, you can always go into the Q&A and enter a Q&A. There is a way to vote for questions that are in the Q&A as well. There will be a time at the end to cover these Q&As, but I also may ask them during the normal discussion if the Q&A questions are related to a follow-up question. One note too, if you want to direct your questions to a particular panelist, please put that panelist's name at the beginning of your question. So our first panelist to speak today is Daryl Duffy, the Adams Distinguished Professor of Management and Professor of Finance at the Stanford Graduate School of Business. Welcome.
Thank you so much, Amy. It's a pleasure to be here. I want to focus on the events of March and how the news of the COVID pandemic hit financial markets with a focus on the US Treasury market. I'm sure it's going to figure prominently in our discussion. I noticed it came up a couple of times from earlier panelists, for example, Andreas Leonard and Dorothy DeWitt. So when bad news hits markets like it did in March, we expect risk assets to sell off. And normally we would expect treasury markets, which are the world's deepest and most liquid markets, to be a safe haven. Treasuries would either rally or at least stay very stable and liquid. But that did not happen in March. And as Fed Vice Chairman Quarles said last week at a Senate Banking Committee hearing, the Treasury market nearly froze up. So why was that, and what might be done about it? I just want to focus on that for a few minutes. So it happened because there was just a tsunami of demands for liquidity, so-called dash for cash, and many investors in treasuries around the world liquidated their positions. And there's been a lot of discussion about who exactly was liquidating. I think the better focus is why was the market structure not able to deal with huge demands for liquidity? And the main reason is that almost all of the investor demands for liquidity must be handled by a small number of large bank affiliated dealers, given the current structure. And the balance sheets of those dealers became essentially stuffed with assets, and their capital requirements wouldn't allow them to absorb more, at least more than a given pace of purchases and staying inside their capital limits. And by the way, I'm not going to suggest that we back off on those capital requirements. Just to give you an example, normally in a given month, since 2000, the median amount of treasuries sold by foreign investors is on the order of $1.25 trillion, which is a lot. But in March of this year, there were over $2.7 trillion of foreign treasury sales to US residents, most of which were dealers. And that's a huge outlier. Volatility in the treasury markets was extreme. The shape of the yield curve became what I would call a wiggly mess. And just on a couple of days in March, the 17th and 18th, if you owned the 30 years, you lost 10% of your market value. Lori Logan, the head of the Fed's System Open Market Operation Desk at the New York Fed, noted in her speech that bid offer spreads that dealers were presenting to investors shot up by a factor of more than 12. And in the interdealer market, the amount of treasuries available at the best three quotes was crushed to about 1/15 of its normal size. And that's confirmed in additional research by Michael Fleming at the New York Fed and in work by JP Morgan analysts. So why was this a problem? Again, basically the dealer balance sheets couldn't handle the flow fast enough, and the Fed had to step in and rescue the market, relieving the market of about $1 trillion of treasuries in just 3 weeks, which is an unprecedented aggressive open market operation among central banks. Basically, post-crisis regulations limited the ability of the banks to handle the market. So going forward, what should we do? Well, I would address market structure. In the Fed's financial stability report that came out just recently, that is supported. There's a supporting statement by Governor Brainerd and another speech by Lori Logan in October that seems to suggest the same direction. Central clearing, I would say, is the first step. The Treasury Market Participants Group estimates that if you're participating in the Treasury market now, your trade is going to be central cleared about 22% of the time. And in my view, that should be increased dramatically. That would improve both the safety and soundness of settlement in the Treasury market, which is paramount in a market of that importance to the United States. but also that would free up dealer balance sheet space through the ability to net purchases against sales quickly. And also it opens the door to all trade by which investors wouldn't need to have a dealer handle their demand for liquidity. In principle, some investors could trade directly with other investors. I'm sure that we're going to come back to this later, and I hope we get to discuss these issues again. Thanks so much, Amy.
All right, thank you. Our second speaker today is Viral Acharya, the CV Starr Professor of Economics at the Department of Finance at the NYU Stern School of Business. Welcome.
Thank you, Amy. I'm going to share my screen. I have a few slides. Just confirming you're able to see it. Are you able to see it, Amy? Okay, great. Thank you. So I wanted to talk a little bit about the corporates and the bank side of liquidity shock when the COVID outbreak happened. And what do we learn from this? This is based on some joint work with Sasha Steffen, who's at the Frankfurt School. So as the COVID outbreak happened, the evidence seems to be that the corporate CFOs and treasurers rushed in for converting all liquidity provisions that they had into hard cash right away. On the left-hand side of the graph, I have plotted here a measure of firms' liquidity, which is its unused credit lines plus cash and marketable securities minus its short-term debt divided by total assets. And what's being shown is the average for the US firms. You see at the top in the black line that the overall liquidity of the corporate sector did not get affected in terms of what they had provisioned. However, when you break it up into components, you see a noticeable rotation taking place in the red circle that I'm showing, especially in the first quarter of 2020. The unused credit lines are declining. They are being drawn down upon, and it's being converted into hard cash into the rising line over there. And this rotation is something that the market also seemed to be rewarding, at least based on casual evidence that I'm showing you on the right-hand side. This can be teased out more forcefully with econometric tests, that if you indexed firms by low versus high liquidity based on the same measure, then firms that had low liquidity did worse than firms with high liquidity by as much as 10 percentage points in their stock returns. So the plot shows the difference between low and high liquidity firms' indices in a return sense, both indexed at 0 in January 2020. Now, even though in the aggregate, this looks like a relatively small rotation, in absolute numbers, this is actually very, very large. In terms of the cumulative drawdowns, which are plotted on the left-hand side, for all large US firms for which we had daily data as of end of June 2020, we observe that just in a span of 3 weeks, close to $300 billion of credit lines were drawn down by US corporates on the banking system, not just United States banks, but whoever had provided them this liquidity insurance. How large is this scale? It's very large. If you had taken a historical stress test of the global financial crisis, US corporates would have drawn down on the order of $250 billion in 1 year. We saw higher than that drawdown in just a span of 3 weeks in March and beginning of April 2020. Now, this has two important consequences for the banking system. One, of course, banks that experience drawdowns have to honor them, and so they provide liquidity. if the drawn down credit lines are redeposited back with the same bank, then there isn't a change. It's just that the credit line has gotten converted into a corporate deposit. But of course, there could be a distributional shift. Maybe some firms draw down credit lines from one bank, but then spread them around in the rest of the system. Second, and perhaps more important, because we don't have an aggregate liquidity problem with the banking system in this crisis, but I think what could be a problem, and what Daryl was also briefly touching upon, is that the credit line drawdowns become term loans on the balance sheets of banks. Now these are drawn down, so there's a solvency risk attached to them. Banks have to provide for capital for these lines of credit, and then that locks up any spare buffers of capital that they might already have had. Now, the vertical line here shows the Federal Reserve announcement on 23rd March to provide support to the corporate bond market through buying bonds. And eventually, in the second week of April, it got extended not just to investment grade paper, but also to the sub-investment grade paper. And you can see that this had the calming influence on the drawdowns. On the right-hand side, the drawdowns are separated by credit risk. You can see at the bottom that the AAA and the BBB rated firms, AAA to A and BBB rated firms, which were also drawing down heavily until the Fed announcement, gradually slowed down their drawdowns. BBB slowed down a bit later because they faced the cliff risk of a downgrade to junk, and the junk support comes from the Fed only in April. But you can see that as a whole, the credit risky firms were more aggressive in their drawdowns, but they eventually tapered off. Viewed in one way, this says that perhaps while everyone has focused on this direct support of the bond market, what the Federal Reserve did through its announcement of the corporate bond buying program was to actually stabilize further drawdowns from the banking system and preventing their capital getting locked up in a significant way. So what does this mean for banks? Now I'm going to turn the liquidity measure to a measure of liquidity risk for a bank, which is going to be its undrawn credit lines that it has provided, plus its reliance on wholesale finance, minus the liquid assets that it has divided by total assets. Now, interestingly, what you see on the left-hand side plot is that while the banking sector liquidity risk wasn't as high as it was just before the global financial crisis, it had been rising quite a bit since end of 2017. And most of this rise is because of the extension of unused credit lines to the corporate sector. Prior to the global financial crisis, liquidity risk buildup was because of reliance on wholesale finance. Prior to the COVID shock, there had been a buildup in the provision of unused credit lines. And if you separate banks by those who had high liquidity risk versus low liquidity risk, once again, on the right-hand side, you find that the COVID shock penalized banks that had high liquidity risk by as much as 10 percentage points. Our assessment is that this is because these banks are now more capital starved because they are their contingent credit lines got converted into cash. Now these become term loans. And once they have term loans, their balance sheet gets locked up into this. And there are research papers now showing that this has had consequences for small business lending of these heavily drawn down upon banks. A last point on this, which is that since then, the cumulative bond issuances have been very, very large, both in the investment grade spectrum and eventually also in the sub-investment grade spectrum. Of course, there hadn't been as much of a narrowing of the borrowing costs other than for the best rated firms, but even that seems to have come down post-August. But a lot of these bond market repurchases are now being used to reverse the credit line drawdowns as the bond yields are coming down because it's cheaper now to issue bonds than to keep repaying the term loans. And so there is some reverse money going back into the banking system, which might stabilize it. of course, it once again begs the question of why so much bond issuance is taking place to start with. Ultimately, when that bond market freezes, will the credit lines get drawn down again? And I think, to me, it reflects perhaps one problem of a large central bank balance sheet, which has not been explicitly acknowledged, which is that perhaps the large central bank balance sheet is just a mirror image of a lot of reserves and liquidity floating around in the banking system. If that is the case, it becomes a put option for liquidity that everyone else can bet upon. And one way this could happen is through unused credit lines on part of the corporate sector, excess issuance in the bond markets. All of these, when they freeze, will result in a drawdown on the banking system, which ultimately the Federal Reserve will have to come and backstop in one way or the other. Let me stop there.
Great, thank you. Now we turn to Isabel Schnabel, who's a member of the Executive Board of the European Central Bank.
So I hope you can hear me well. Yes, okay, perfect. Yeah. So thank you very much for inviting me to this conference. It's a real pleasure to be part of this excellent panel. So I would like to make 2 points focusing on the euro area. So first, I will discuss the role of the non-bank sector during the market turmoil in the spring, and will provide some evidence on how it likely contributed to amplify a broader market stress. And second, I will explore some of the regulatory gaps that need to be closed to strengthen the resilience of the non-bank financial sector. So this is not working, can you? Okay. Non-banks have traditionally played a major role in credit intermediation in the US. In the euro area, however, we have seen a notable rise in the role of non-banks only after the global financial crisis, which you can see very clearly on my first slide. There are significant advantages of having a broad and diversified financial system, but the market turmoil in the spring has shown that a large non-bank sector can be a significant amplifier of systemic stress. Next slide, please. So on the left-hand side, you can see that in the euro area, the investment fund sector alone sold securities worth almost 300 billion euros, or 3% of their assets under management, in the first quarter of 2020. And on the right-hand side, you can see that many investment funds faced large outflows, and in particular, the high-yield funds. But our data suggests that investment funds sold significantly more securities than those that euro area end investors withdrew. And there are 3 broad factors that likely amplified the pro-cyclical selling by investment funds. Next slide, please. So the first is the mismatch between asset liquidity and redemption policies. Bond and equity funds entered this episode with historically low cash positions. And when redemptions rose, fund managers had to seek liquidity at a time when the capacity of markets to provide that liquidity had diminished sharply, resulting in forced asset sales. And on the left-hand side, you can see that outflows during the peak of the crisis, so these are the yellow dots, clearly exceeded median cash holdings, so these are the blue dots, for all types of corporate bond funds. The second factor relates to fund leverage. Volatility targeting funds have grown rapidly in recent years, and these funds typically use leverage when market volatility is below target, as it was before the pandemic. And they have to liquidate leveraged positions when market volatility surges. And so when cross-asset correlations spiked in March, as shown on the right-hand side, investors had to rapidly reduce leverage and sell assets, including the supposedly safer ones, in line with what we observed in the spring. Next slide, please. The third factor relates to margin calls. Of course, margining requirements are an important safeguard to reduce counterparty credit risk, but they also increase liquidity risk, particularly when liquid asset holdings are inadequate. And as you can see on the left-hand side, initial and variation margins collected by 4 key European central counterparties increased by around 60 billion euros during the peak of the crisis. And to meet margin calls, some euro area insurers and pension funds had to liquidate shares held in money market funds. So the right-hand side chart shows that there was a striking correlation between margin calls and money market fund outflows over the period of market stress. So low liquidity buffers, leverage and rising margin calls gave rise to perilous price spirals that threatened to destabilize the entire financial sector. Next slide. So on this slide, you can see that credit spreads and CDS spreads diverged on the left-hand side, and that there was a historical widening in net asset value spreads for ETFs. So liquidity essentially dried up. Next slide. And as Daryl and others have shown, the market dislocations in the US Treasury markets, which you can see on this slide, can be partly accounted for by non-banks heavily relying on government bonds for their liquidity risk management. And the same could actually be true for the euro area. The next slide. So systemic stress is measured by the KISS index, which you can see now on my final slide, increased to levels close to those seen during the global financial crisis, both in the US and the euro area. And forceful monetary policy action eventually succeeded in stabilizing financial markets, and this is also very visible in this graph. Asset purchases, both public and private, quickly address the issue of illiquidity and reduce systemic stress. But the success of central bank intervention should not distract from the fact that the underlying vulnerabilities in the non-bank sector need a structural fix, not least to mitigate the risk of moral hazard. I see 3 areas for further reforms to curb systemic risk in the non-bank sector. So first, we should think about the amount of precautionary cash holdings that non-banks should hold, and rethink their redemption policies, in particular with respect to the length of notice periods. Second, we need to make sure that authorities can make effective use of their ability to limit leverage in investment funds. And third, we should review the liquidity requirements for money market funds and their portfolio composition, especially for the low volatility net asset value funds, given their vulnerability to liquidity shocks. And I would like to conclude here. Thank you very much.
All right, thank you. The next panelist that we'll hear from is Ben Golub, the Chief Risk Officer of BlackRock.
All right, thank you, and I'd like to thank the organizers of the conference. They set out early to organize this event, and we had to envision that maybe we wouldn't be able to travel, and sure enough, that was the case. Let me share my screen. Okay, so experience has taught us that sometimes when a financial product grows at a rapid rate, it's a sign of some underlying instability and a potential concern for future systemic problems. And if you can see on my slide, I'm bringing back some bad memories from the GFC, where you can see the rapid growth of non-agency MBS. Now this slide, it shows the rapid growth of another product, which are fixed income ETFs. And certainly in terms of its rapid growth, one might wonder, is that proceeds to some sort of systemic problem in the future? And you know what I'm going to discuss today are reasons to not only not have that concern, but to the contrary, to see the stability enhancing features of the ETFs. And you know, there's sort of a question that a lot of people struggle with it at an intuitive level. You know, how can it be that taking something illiquid, putting it into a liquid wrapper, isn't just setting the stage for some sort of, let's call it phony liquidity, and under stress that would be unwound. I think the argument that I'll make is that the structure of the ETFs, they've learned a lot from the world of securitization, and they've learned a lot by creating mechanisms for efficient arbitrage that offset that. But most importantly is the fact that the ETFs have an in-kind mechanism by which they are long the securities that were there to be a redemption, they actually have to produce. So in some sense, because of that simplicity, there can be no mismatch for an in-kindable ETF, precisely because it's already, fully reserved, if you like, for the liquidity needs that may happen. So I have on the that's theory, but I have some charts that will hopefully let you understand why we think that. And I'll make five points. Looking at the stress test, the mother of all stress tests from the COVID crisis. And you'll see here in terms of secondary market trading for the ETFs, you'll see in the month of March, a massive increase, so that it was the case that the ETFs were net providers of liquidity in the marketplace because it happened. Point two speaks, if you understand the ecosystem of ETFs, there's something called an authorized participant, and they make primary market transactions with the ETF if there's a mismatch in terms of the value of the assets versus the price of the ETF. And you'll see that that part of the ecosystem also was robust. And we can see again in March that the primary market activity from the APs to the various ETFs responded to the crisis. Point three is showing that the actual, and I guess this alludes a little bit to, I think, what Darryl was saying. It shows a comparison of the bid-ask spreads for the treasury-based ETFs, which is the green line, you can barely see a blip on it, versus what happened in terms of the treasury market. And granted, there were some other effects, but again, the argument that I'm making is that the ETFs were liquidity enhancing because you could actually trade them much more efficiently. There's a question in terms of valuation that you have these physical assets, they trade on the market, that valuation may actually differ from what is perceived to be the net asset value of the underlying assets. And I think what we've learned is that what sometimes appears to be a mismatch or a defect in the structure of the ETF is actually more an example of the ETF market responding more quickly to shocks in the market than the net asset values which are associated with the funds. The net asset values by their very nature are based upon, particularly in the bonds, estimates or very thin trading. Whereas in the secondary market, let's say on March 12th, which was a day when there was a 7.5% quote unquote discount to the NAV, which we're showing over here, there were more than 1,000 trades in the secondary market in ETF. So the question is, was there a discount to NAV, or was the NAV lagging the secondary market, which was showing and trading the bonds as a discount? Then, of course, there was a reversal of that. To put that into some context, over 1,000 trades on the ETF versus in the case of the top 5 bonds in that ETF, it traded on average 37 times over the course of the day. So we think that what's happening is that the ETFs are providing more price transparency to the market, as well as mechanisms to rebalance portfolios and risk. Certainly there are ways to improve the ETF ecosystem, and we won't go into that at the moment. But has been responsive to the crisis rather than the market of the.
It looks like we're having some connection issues. You back? Then you're on mute. You're on mute right now, Ben.
All right, I guess that was the electronic hook. Thank you.
All right, well, our last panelist today is Antoinette Shore. She is the Stuart C. Myers Horn Family Professor of Finance at the MIT Sloan School of Management.
Good morning. Thank you for having me. It's a pleasure to be here. The market I want to talk about is the housing market. And actually, for once, this has been a bright spot in the crisis, and neither the catalyst, not even so much an amplification mechanism. And I would argue some of the things that really went well during this crisis in the housing market are also lessons learned, maybe very painfully from the last crisis. So if you remember, right, one of the big problems in the 2008 financial crisis was that despite record low interest rates, many mortgage holders were shut out from refinancing or even loan modifications because their LTVs had spiked. And then due to the structure of private securitizations, private origination, a lot of loan servicers were not willing to modify or refinance, which ultimately is not in the interest of the mortgage market, because the ultimate holders of many of those risks, like Fannie, Freddie, the Ginnie Maes, and so on, would have actually benefited from the refinancing and from the lower payments, and with it, the lowering of credit risk. And what we've seen in this crisis, luckily, is that we did learn some of these lessons. So I would say that the agencies in particular pushed strongly and quickly for, number one, despite income dropping and therefore income and many people losing hours and even jobs, allowing refinancing to the lower rate. We also put in place forbearance for homeowners in distress. And the forbearance is not just a mechanism that relieves home mortgage holders for payments right now. If you weren't in default before the pandemic hit, you will not be penalized with penalty rates, nor actually with a dent on your credit rating. But of course, homeowners will have to repay after the forbearance stops. So these are all, in my mind, very good mechanisms that allow homeowners to smooth cash flow expenditures in a time of cash flow stress and cash flow risk. And of course, we should also not forget that because of very generous CARES Act support in the beginning of April and May, probably it was possible for many mortgage holders to make their payments. Actually, for a few months in the middle of this year, we actually saw that delinquencies in subprime mortgages were relatively low relative to the change in the more prime mortgages, potentially because the CARES Act checks were particularly valuable for lower income households. Now, the last thing I do want to say is that while I believe, kind of these type of forbearance and smoothing mechanisms are working very well for homeowners. The same cannot be said for renters. And of course, the difficulty is that renters don't have an asset against which one could backload their rental payments and smooth them over a very long time period. Which actually kind of, if you look at the data, there are a number of estimates that have said that by the end of this year, when, moratorium on rental payments will finally completely expire, more than 12 million renters might actually be faced with late payments of over $5,000 per person, which is often very, very difficult for these households to make. And so, I think going forward, we should think hard about how to provide a better smoothing mechanisms if, ever a similar crisis would occur that allow, the entirety of US households to benefit from the type of smoothing that was possible in the housing market. One thing, for example, that I think is a good start is that, for example, Fannie and Freddie provide multi-family owners who are renting out their properties. They're allowing them to go into forbearance if on the condition that they suspend all evictions of their renters. And so putting in a way more incentives into the system to efficiently renegotiate rent and not just subsidize rent through, say, transfers in the CARES Act would be something that, kind of would actually stabilize overall people's housing situations. And I think also would actually encourage a better functioning of pricing in the rental markets. Thank you.
All right, thank you. Well, following the 2008 crisis, many market participants built tools to manage risk exposures. What was the effect of these tools on the crisis last March? Were they beneficial? And how have the various capital requirements and payout restrictions affected the credit markets? Daryl?
Well, story is good and not good in some respects. In terms of the stability of the banks, the rules performed admirably well. The banks were a source of strength to the financial system and to the economy more broadly. The capital requirements, as I mentioned in my opening remarks, prevented the banks from providing more liquidity to bond markets. But I would not back off on those capital requirements. If anything, additional capital requirements might be beneficial, and restructuring them so that the supplementary leverage ratio doesn't limit the ability to intermediate safe, high quality liquid assets would be a good idea. In terms of funding, banks were told by their supervisors not to dip into daylight overdrafts or to take any risks that they would fail to meet their resolution planning and recovery liquidity requirements on an intraday basis. And that really played havoc with funding markets. So somehow or other, if the Fed can convince banks that during a stress period, it's okay to overdraft, it's okay to draw on a discount window, and to use their abundant amounts of reserves to provide liquidity to funding markets, that would have been much better, and it will be much better if the Fed can figure out that one. In the meantime, I would say abundant amounts of reserves will be the order of the day in terms of funding market liquidity until that other problem is solved.
Daryl, I think, and Isabel has something to add. Who wants to go first?
I mean, first of all, I fully agree with Daryl that, I mean, also in the Euro area, the post-crisis reforms in the banking sector actually overall had a very positive impact, and they made it possible that banks in the end were part of the solution rather than part of the problem. So the same cannot be said for non-banks because, I mean, as I also stressed in my introductory remarks, there actually there was very little regulation that was introduced after the global financial crisis. And this regulation was mostly motivated by investor protection rather than systemic stability. And so this, I think, is actually a big gap that we really need more macroprudential tools in the non-bank sector. On the payout restrictions, which of course are highly controversial. So we are very concerned that the bank lending channel may not remain intact in the future. So far this has worked very well. But of course, I mean, as you know, Euro area banks are not very profitable. There is probably going to be a sharp rise in NPLs. We already see the rise in loan loss provisions. And so we know that lending depends very much on bank capital. And so I believe that actually the supervisory recommendation to abstain from payouts was very important. It was also very important that this was done in the Euro area on a system-wide basis in order to avoid stigma. Of course, this is a crisis measure and it should be monitored and evaluated regularly and then at some point also be lifted. But at this point, I think it's very important.
Yeah, I just wanted to add something to what Daryl said, which is that, US banks have lost a very big chunk of their market capitalization since the COVID shock. In contrast to what everyone thinks are the COVID sensitive sectors like airlines, transportation, and so on, actually the two sectors that are most sensitive to news about COVID and vaccine are actually banks and energy sector. And bank lending standards are very tight. This is revealed in the senior loan officer survey of the Federal Reserve. So I'm a bit stumped as to why the Fed is not asking banks to raise capital right now. I thought one of the lessons we learned during the 07-08 crisis is that no matter how bad you think the situation is right now, there is a worst possible situation tomorrow that could arise. I can easily see, given the infection numbers we are seeing in the United States, especially, that there is considerable uncertainty about what could happen down the line, even if we think in 9 or 12 months, a big chunk of the population might get vaccinated. I think we are taking a little bit of a gamble on bank balance sheets here, hoping everything will turn out all right. I think if banks are well capitalized, I don't see why the bank lending standard should be so tight. I think so something doesn't square up in Federal Reserve's assessment of the banking system, in my view. I think they should be asked to go and raise capital now. A big chunk of their losses have happened because of exposure to the energy sector. I don't see this sector performing that well post-COVID for a variety of reasons. And so it's possible that some of this capital is not just kind of just going to bounce back in the stock market valuations of the US banks. So I keep asking this question. I have not yet had a satisfactory answer other than a little bit of inertia that if we ask banks to go now, it might send some bad signals. But if you ask them collectively, actually uncertainty about the system may come down. They might get a little bit more comfortable making loans and encouraging some renegotiations that are required.
Okay, thank you. I'd just like to remind the audience to use the Q&A box to add any questions that you have for our panelists. The next question I have for the panelists is, many fear distributional effects from COVID-19 in the markets. Can you comment on how likely markets will experience distributional effects and on whether you have observed any up to now?
Yeah, Antoinette, go ahead.
Go ahead, Viral, you can go first.
Yeah, I was just going to stress one point, which is that you're already seeing a distributional effect in availability of credit. Large firms that are in the public bond markets are borrowing at ultra low costs, thanks to the Federal Reserve put option, whereas small banks, which are bank dependent, are actually not getting the lending because bank capital, at least in terms of lending standards, is very tight right now. I think this has always been one problem with using the Federal Reserve balance sheet to transmit to the real economy without ensuring that banks are actually transmitting it to the small firms and the households at the same time. So I think this one distributional consequence, at least from a financial standpoint, could possibly be looked into.
I agree with this. I also wanted to add there are some direct ways how the crisis is affecting the different parts of the income distribution. On the one hand, you know, clearly in the housing market, we see that people who are able to participate in mortgage markets are benefiting from the very low interest rates. You might have seen that, you know, in Q3, house sales actually bounced back, in particular secondary homes in the countryside, and you know, kind of obviously people who can participate in housing markets are benefiting from the low interest rate, while renters, as we discussed before, not so much. But there's a second part where I think we need to be really careful is if you look at how the paycheck the PPP, the Paycheck Protection Program has affected small businesses, it has actually very directly contributed to a very unequal allocation of resources. So we know from a lot of research that the Paycheck Protection Program was rolled out very unevenly across the country, across geographies, also across large versus small firms. In my own research, we actually have found that if you look at the larger small businesses that have had access to the Paycheck Protection Program, a lot of it actually went just into balance of the households that were receiving those or had access to this support, even though, you know, it looks much more that they were not able to spend the money because due to just constraints of, you know, going out and spending and consuming, especially richer households voluntarily reduced their consumption, while actually the smallest of the small businesses had a very difficult time to get access to the Paycheck Protection Program. And so I think through the way we rolled out many supports structures, a lot of inequality has actually, unfortunately, been built into the system.
Thank you. I'd like to draw your attention to transparency and think about transparency either in terms of market information or issuer information. And think about the role of transparency during COVID. Was there too much information revealed about some things, not enough information about others? And would you recommend any regulatory changes to transparency based on lessons from COVID, you know, considering, you know, how it might have benefited the market and how much it could cost to implement? Go ahead.
I keep coming back to the Treasury market, but I find it puzzling that even today we're unable to see transactions in the Treasury market in public data feeds. FINRA has been collecting transactions-based prices and quantities for some years now, and they're available to regulators only. They're not actually complete. They don't even allow regulators to find out the comprehensive LEIs, that is the identifiers and timestamps. So going back, for example, to Isabel's point about who is liquidating treasuries, we actually don't know very much about that. It seems to be coming from all quarters, foreign official sector, mutual funds, hedge funds of different types, both cash futures basis trades and risk parity trades. We honestly don't know very much about that because we don't have enough data on Treasury transactions. And we should bring Treasury markets up to the level of Europe's MiFID II. In Europe, they're actually able to see trades of US Treasuries that are conducted in Europe, whereas we in the United States cannot see those US trades of Treasuries. So we should have what we have in the corporate bond market, which is improved market transparency. And actually, from what I understand from mutual fund managers, actually made a big difference in March in terms of providing information to mutual funds and other investors about where what corporate bonds were good deals and bad deals in the corporate bond market, improving price transparency. So I would go for more transactions data.
Ben?
Yeah, I would certainly agree with everything Daryl said. I was going to highlight that the improved data in the corporate sector, the trace data in the high yield sector has made a big difference as a practitioner trying to develop methodologies and frameworks for managing on a proactive basis the liquidity, whether it be in a fund, and making sure that the liability of the fund relative to the assets of the fund is rational. You know, a lot of these things were conceptually simple, but empirically impossible. And there's been a lot of progress. So, you know, we have been trying to build up databases of transactions to develop empirical models where we can. In some cases where that data doesn't exist, you know, we will rely on basically traders' estimates, and which literally involves going and asking people, how much do you think we could execute in this market or that market? But where you have data, it's more methodical, it's less subject to the educated guesses of traders, and many market participants may not even have access to people with that informed knowledge to make those intuitive guesses. But there's been a lot of progress so far, and hopefully as we evolve, there'll be additional data so that practitioners can actually go about trying to create rational portfolio structures. Thank you.
Isabel?
So was me? I didn't hear. Did you? Yeah. Did you mention me? Okay, because I didn't hear. So thank you. So I would also like to make the point that, of course, there has been a lot of progress that has been made after the global financial crisis. And I mean, MiFID was mentioned by Daryl. I mean, we also we now have much more information about the derivatives markets, and there are also the move towards central counterparties played a very important role. So there's much more transparency now on the derivatives market, which I think is important. Of course, there are still large data gaps. And again, I would like to come back to the non-bank sector, because actually for us, it's a big problem that we do not have granular data on the non-banks. So we know quite a bit about the banking sector, but we know very little about the non-banks, and especially about their exposures to liquidity risk. And this has become much more important. And therefore, I think that's an important data gap.
All right, thank you. We do have several questions from the audience. The first one is for Isabel. Could you repeat the reforms that you think are necessary in the non-bank sector to mitigate the cyclical influence on market stress?
Yes, so I basically pointed out three reforms. And so the first was that we have to solve the problem of the liquidity mismatch in the non-banks. So we have this mismatch between the redemptions that can happen anytime, and a lack of liquid assets on the asset side. And so there, I mean, the funds have introduced some measures on a fund-specific basis. Some funds have done that, but we basically don't have anything that takes care of the systemic perspective. And so we have to think about redemption policy. So I think that would be very important. The second is the question whether we should limit leverage in investment funds. That was the second point I mentioned. Then the third was liquidity requirements for money market funds.
Thank you. And we have a question for Ben next. The reason why we saw a large discount during very early March was precisely due to no transparency or liquidity in underlying bond markets, hence the wide discount, as APs and other participants themselves were not fully informed, hence the large bid-ask spread. However, once the Fed came to rescue through their policy put for bonds and corporate ETFs too, we saw a large premium back. So yes, ETFs helped to do portfolio trades, rebalance, but underlying valuations were not readily available. In hindsight, happy to see that fixed income ETFs worked well. Do you have a response?
Well, certainly happy that they worked, of course. But structurally, I think we saw a validation of the concepts. The APs were there. They were concerned that they would disappear. Transactions occurred during periods of market stress. What I tried to show with the data, it was only a certain amount of granular data given the time frames that we could use today. The arbitrages that were required occurred, and there were times when the market was uncertain and the value of the corporate bond was in fact what the ETF said it was, not the other way around. So if you like, there was a mechanism by which price was revealed to the marketplace via, like I said, trade numbers in the thousands by the transactions in the primary market. So that transparency was very useful, and clearly people were able to manage risk and actually use, in some cases, the ETFs as hedging instruments directly to manage risk.
All right, thank you. Why don't we do one more question that we have time for. So this one is directed to Daryl and Isabel. Daryl suggested increased clearing for Treasury markets. On the other hand, Isabel showed increased margin requirements during the spring. Would increased clearing of Treasuries risk a liquidity spiral during times of stress?
Okay, I'll start on this. I'm sure Isabel will have more. So central counterparties demand minimum margin requirements that should be robust enough that they don't have to be increased a lot during stress periods. In the bilateral uncleared market, for Treasury repos, there's actually a convention in the market is no haircuts. So that results in either an unsafe condition or a situation in which you're encouraging investors before the stress to take a lot of leverage and then to unwind rapidly when there's a stress period, because obviously, regardless of margin, there's variation margin that requires you to unwind your position if you're losing money on it. So in my view, the centrally cleared market is much safer in terms of unwind risk than the bilateral uncleared market. And it's shown to be working quite well in the swaps market, which went through an enormous reform after the great financial crisis. And now over 90% of standard interest rate swaps are centrally cleared, and we didn't see any significant problems there with unwind risk or there were definitely increased margins, but there was, of course, increased volatility. The market performed well and has remained liquid, much more liquid than it was before the central clearing mandate was imposed on that market. I'm not sure if Isabel may have more to add on that.
So no, actually I don't have much to add, but I fully agree with what you said, that I would consider that as a stabilizing factor rather than as a factor that further fosters procyclicality. So I think what you describe is perfectly valid, and the experience shows that.
All right, thank you. It appears we have come to the end of this panel. It was fun. Thank you very much to the panelists, and thank you very much to the Office of Financial Research and the Cleveland Fed for putting together this panel. And I will turn it back over to the organizers.
Thank you very much. Bye-bye.
Thank you. Bye-bye.
Thank you, Amy.
Thank you.
Well, thank you to Amy, Viral, Daryl, Ben, Isabel, and Antoinette for your insights and remarks. I think it was a very interesting panel. We now will have a break for about half an hour while we prepare for our keynote speaker, who will be Governor Michelle Bowman of the Federal Reserve. See you, all of you, hopefully, back at 12:35 Eastern Time. Thank you.
Hi, Governor Bowman. It's Gianna.
Hi, Jana. Can you hear me?
I can hear you. Can you hear me?
I can, yes. So I should probably start my video, huh?
So you can wait to start your video until the session will start at 12:35, and Joe Halbrick will introduce Loretta, and then Loretta will introduce you.
Okay, great. Thank you.
So for now, you can just keep your audio muted and your video stopped, and then once they introduce you, you can turn everything on.
Okay, and should I call her Loretta or President Mester?
That is up to you.
Okay.
I would say Loretta, but that is up to you. Loretta is here.
So I just want to make sure that I don't do this wrong. So if I start sharing my video, is that just going to show up at the beginning whenever you turn everybody on, or does it show up before that?
It shows up. So technically everyone is on now. So okay. If you turn on your video, we would see you now. So
I will not.
Hey, Mickey.
Hi, is that Loretta?
Yes, it is.
I'm going to turn my video on so you can see me.
Okay, great.
How are you?
Oh, I'm well, thank you. How are you?
Good. Thank you so much for doing this.
Oh, well, thank you for the invitation. So hopefully it'll be an interesting discussion on non-bank.
So far, the conference has been very interesting. I mean, a lot of good work and conversation and questions. So I'm sure you will generate a lot. So.
Well, I wish I could have attended in person, but unfortunately that's just happening these days. But your office is gorgeous. Goodness.
Yeah, I've been trying to balance, being in, because we have the cash operations. So I like to come in and see these guys and the Ellie, the law enforcement people and things. So I ended up being in Cleveland this week. So I was going to be in the office. So, but it's interesting because I had to learn the technology here as opposed to on my laptop. And it's but I think I have it all working. So.
Well, good. I'm glad your laptop works. Ours doesn't. So I'm sort of on an iPad and laptop and trying to make sure I don't look silly while I'm trying to read my, make sure I get the remarks right and then look at the camera in the right place. So this will be interesting. You can let me know how it works
that's the biggest thing is looking in the camera in the right place. I think that's really hard. I read somewhere where they're trying to devise an iPad where the camera's actually in the middle of the iPad.
Yeah, that would be a good evolution, I think. That and maybe just using it more because we use primarily, they encourage us not to use our iPads. So it is.
Well, it'd even be nice if it was on the longer side of the iPad. So if you set it up so it's like a screen, you look just like you do on your laptop.
Yeah, absolutely.
You know what I mean?
I do. I know exactly what you mean. Yeah,
you look good on the award ceremony, the Yellen Award ceremony. I thought you looked good there.
Oh, thank you. From my office that has nothing on the walls and nothing on the shelves because we want to unpack all of our books and everything. So we'll once we get a real house, we'll figure all that out. Not a good market for that right now.
Well, that's the way when I'm in Philly, that's what it looks like. There's nothing on the walls or anything. Everyone says, wow, that's so drab. I'm like, I kind of like it like that because then no one can sort of see what you have.
Minimalist.
No judgment. No one can really judge you.
Oh, they try. Well, good. Well, Loretta, this is great. I'm so, this has been a real interesting process. getting a topic and refining it and working with our financial stability team. So I'm grateful for the opportunity to have gotten to know them this much better through that process. It's been really, really great to get to know Andreas's team better. But great topic today. And how late do you go tomorrow as well? How long is this conference?
And then there's another, yeah, because this is basically like 8:30 to 1 today, and then similar tomorrow. So
great.
You know, it's usually usually organized like a full day the first day and then half a day. But I think it's hard to be in one place at one time on a video. So we had our Conference of Presidents meeting on Monday, and it was basically started at 11 in the morning and went till 7 at night with like very few breaks. And it was pretty hard.
That's worse than an FOMC meeting.
Yeah, it was pretty difficult.
Yikes. Well, I didn't get a chance to thank you aside from that email correspondence we were doing, but I really appreciated your comments on the community banking issues that we've been working on with the CBO group. I always forget, CBOMG, I believe is what they're called, but they're super excited about it. And I think it was good to sort of moderate the excitement and put a little bit of a governor on it, which is good.
No, that's always good because you'll see the bigger picture sometimes that they're not seeing. I think that's always a good thing. And I think they like that perspective too, because they know that, right? They know there's other things.
Loretta and Governor Bowman, I just want to remind you that everyone can hear you if they're not at lunch.
Oh, okay.
Interested as they are in what Loretta has on her apartment walls in Philadelphia.
Nothing.
Thank you.
That's easy. That. Thanks, Joe. We thought we were in a private room.
Important to be reminded, I think. Fantastic. So we start at 12:35, and then you finish when I finish my remarks. Okay, great.
Yes.
Thank you.
Loretta, if you want, you could stop your video until Joe starts the session, or you can leave it on. It's up to you.
Welcome back from break, everyone. I hope you had a good break. And now I would like to welcome back President Loretta Mester to introduce our keynote speaker for today. Loretta?
Thanks, Joe. Thanks very much. A lot of times when you're asked to introduce someone, you always say, it's my pleasure this afternoon to introduce XYZ. And I really mean it. It really is my pleasure to introduce our keynote speaker today, Michelle Bowman, or as she's known, Mickey Bowman. Governor Bowman took office as a member of the Board of Governors of the Fed in November 2018. And what's great about Mickey is that her background made her a very valuable addition to the Board of Governors. Before she joined the Fed, she served as the State Bank Commissioner of Kansas. And before that, she also served as a vice president of Farmers and Drovers Bank in Kansas. I think it's accurate to say that banking is in Mickey Bowman's blood. She's a fifth-generation banker whose great-great-grandfather, W.H. White, helped found the Farmers and Drovers Bank in 1882. So it was very natural that Mickey would be appointed as the first person to fill the community bank seat on the Board of Governors. And of course, that was a position that was created by Congress in 2015. Now, in addition to her experience in the banking industry, she also has extensive experience as a public servant, which again, we think of ourselves as public servants when we're at the Fed. She's had positions on the staff of the US Senate, the US House Committee on Transportation and Infrastructure, the Committee on Government Reform and Oversight, the Federal Emergency Management Agency, and she was Deputy Assistant Secretary and Policy Advisor in the Department of Homeland Security. She has a BA in Advertising and Journalism from the University of Kansas and a JD from the Wabash University School of Law. And she's a member of the New York Bar. And if you know about the New York Bar, that's a really hard one to be a member of in terms of getting past the bar exam. Now, in her 2 years on the Board of Governors, Governor Bowman has made significant contributions to the Federal Reserve. She oversees the smaller regional and community bank supervision, and she's initiated a project to ensure that the supervision of community banks is effective without being overly burdensome. And she also serves on the committee that oversees the Federal Reserve banks, which is sometimes a thankless task, but hopefully she feels that it's something that has not been thankless, but has actually been valuable. It's great having her to talk to about our activities in the reserve banks. And of course, last but not least, she's also a very valuable member of the Federal Open Market Committee. I can tell you that her comments are always interesting, are always listened to very carefully by the rest of us around the table. And, Mickey Bowman is a very busy person, as I'm sure you can appreciate. So I'm really pleased that she's made the time to share her wisdom with us today. So Mickey, please take the microphone.
Oh, Loretta, thank you. That's such an impressive introduction. I really appreciate that. And thank you so much for the opportunity to be here with you today. Good afternoon, everyone. It's really a pleasure to be here to share a few of my thoughts on financial stability issues with you. I'd like to thank the Cleveland Fed and the Office of Financial Research for hosting this conference, and especially, again, for that very kind introduction, Loretta. It's encouraging to me to see so many great minds devoting their time and attention to studying financial stability. At the board, we dedicate considerable attention to this topic as well. And I'd also like to thank my colleagues, Vice Chair for Supervision, Randy Quarles, who also serves as the chair of the Financial Stability Board, and Governor Lael Brainerd for their leadership on these issues, both internationally and at the board. So now's a good time, and it seems especially relevant to look closely at financial stability, as the COVID-19 pandemic has had a profound impact on the US economy, and it's tested the resilience of our financial system over the past 9 months. Efforts to contain the virus triggered an economic downturn that was unprecedented in both its speed and its severity. And early on, more than 22 million jobs were lost in March and April. And though a significant number of people have returned to work since that time,
we still face a shortfall in employment relative to its level prior to the pandemic. Fortunately, both our economy and our financial system were very strong when the pandemic hit. Most banks began 2020 with higher capital ratios and more liquid assets than they had in previous downturns, which really helped them remain a source of strength in March and April. But as the crisis intensified in March, serious cracks emerged in several areas of financial intermediation crucial to the health of the economy, including treasury markets, corporate and municipal bond markets, money market mutual funds, mortgage real estate investment trusts, and residential mortgage markets. Today, I'm going to focus on the strains in mortgage markets. To address strains in mortgage markets, the Federal Reserve took prompt action to purchase large quantities of agency guaranteed mortgage-backed securities, or MBS, because we learned during the previous financial crisis that the proper functioning of mortgage markets is necessary for monetary policy to support the economy. Unfortunately, the problems in mortgage finance in this crisis were broader than just in the MBS markets. This crisis period has also revealed a number of new, or in some cases renewed, vulnerabilities related to lending and loan servicing by non-bank mortgage companies, which I'll refer to from here on as mortgage companies. These vulnerabilities were not entirely a surprise to me. When I served as a banker and subsequently as the state bank commissioner in Kansas, I saw firsthand the increasing share of mortgage companies in mortgage origination and servicing, as well as some of the weaknesses in the mortgage company business model. And in my role as a board member with a focus on community banks, I frequently hear about the issues that have caused some regional and community bankers to pull back from originating and servicing mortgages. I view this as a significant problem because I believe firmly that a healthy financial system must have a place for institutions of many different types and sizes and be able to serve the varying needs of different customers. So I'll begin today by describing the evolving role of mortgage companies in mortgage markets and the risks to financial stability that activity entails. I'll then focus on developments in mortgage markets during the COVID-19 pandemic and discuss how actions by the Federal Reserve and other parts of the government help stabilize financial markets and prevent more severe damage to the economy. Finally, I'll explain how vulnerability is associated with mortgage companies could pose risks in the future. And I'll review ongoing work across the regulatory agencies to monitor and address these vulnerabilities. And then I'll end by enlisting your help. Figuring out how to achieve a balanced mortgage system, one that delivers the best outcomes for consumers while being sufficiently resilient, is a highly complex task that could benefit from the insights of those of you here today. So let me talk about the role of non-bank financial institutions in mortgage markets. In the 1980s and 1990s, the share of mortgages originated by mortgage companies increased considerably as expanded securitization of mortgages allowed mortgage companies, which lack the balance sheet capacity of banks, to compete with banks in the mortgage market. The role of mortgage companies increased further in the 2000s with the growth of the private label mortgage market, where MBS sponsors are private firms without government support. But the last financial crisis and the prolonged housing slump that followed led to a sharp contraction in mortgage company activity. In 2006, mortgage companies accounted for around 30% of mortgage originations. By 2008, at the bottom of the housing crisis, this share had fallen to around 20%. In the past few years, the market share of mortgage companies has risen sharply, well surpassing their share before the housing crisis. Today, these firms originate about half of all mortgages, including more than 70% of those originated and securitized through Ginnie Mae and the government-sponsored enterprises GSEs of Fannie Mae and Freddie Mac. Non-banks also service roughly 3/4 of mortgages securitized through Ginnie Mae, and about 1/2 of those securitized by the GSEs. Although some mortgage companies specialize in origination or servicing, most large firms engage in both of these activities. The expanding presence of mortgage companies has brought benefits to the consumer and the economy. And among these benefits are increased competition and technological innovation. Mortgage companies are generally able to act more nimbly to changes in market conditions, and they've been faster to deploy new technologies like online mortgage origination platforms. But the rising share of mortgage companies has also brought with it increased risks. I'll focus here on the risks most relevant to financial stability. One major vulnerability of mortgage companies is liquidity. That is, their ability to finance their portfolios of assets. Unlike banks, mortgage companies typically do not have access to liquidity from the Federal Home Loan Bank or the Federal Reserve System. Mortgage companies also don't have access to deposits as a stable funding source. So while banks will hold some originations on their balance sheets, mortgage companies first fund their originations on warehouse lines of credit that are usually supplied by banks. Typically, after a couple of weeks, the mortgage company repays the warehouse line and securitizes the mortgages. During the last financial crisis, when the private label mortgage securitization market started to freeze, mortgage lenders could not transition their originations from the warehouse lines to securitization. Warehouse lenders became concerned about their exposures to the non-bank companies and cut off their access to credit. As a result of this funding crunch and other factors, many lenders failed, including household names like New Century Financial Corporation. The risk of events like this one repeating is probably more limited today because mortgage companies primarily originate mortgages that are securitized through the far more stable GSE or Ginnie Mae markets. Instead, the main liquidity concern today comes from mortgage servicing. If borrowers don't make their mortgage payments, mortgage servicers are required to advance payments on the borrower's behalf to tax authorities and insurers. Although servicers are ultimately repaid most of these advances, they need to finance them in the interim. The servicer's exposure is greatest for loans securitized through Ginnie Mae, as they require servicers to advance payments for a longer period than the GSEs. In some cases, servicers may also have to bear large credit losses or pay significant costs out of pocket. Because mortgage companies are now the major servicers for Ginnie Mae, this liquidity risk and possibly solvency risk is a significant vulnerability for these firms if borrowers stop making their payments. If these firms collapse, what are the repercussions? Clearly, there's considerable potential for harm to consumers, and that harm would likely be concentrated in communities that are traditionally underserved. In recent years, mortgage companies originated the majority of mortgages owned by Black and Hispanic borrowers, as well as the majority of mortgages to borrowers living in low or moderate income areas. But what does this have to do with financial stability? One aspect of financial stability is the amplification of shocks. In other words, how a problem initially confined to one part of the financial system can spread to involve broader swaths of borrowers and investors. During the housing crisis, the fragility of mortgage companies was an important source of this amplification. In particular, rising mortgage defaults led to the collapse of many mortgage companies, which in turn was one of the key drivers of significant pullback in the supply of mortgage credit. That tightening in credit then weighed on house prices as potential homebuyers who once would have been able to get a loan found mortgages expensive or impossible to obtain. As a result, Even families who had not been involved in the mortgage frenzy of the mid-2000s found the prices of their homes falling sharply. Today's housing market is much more robust, and the risk of a severe crisis originating in this sector is currently low. But nonetheless, if some large mortgage companies fail and other firms don't step in to take their place, we could see adverse effects on credit availability. So I'll talk now about some policy responses to the COVID-19 crisis. Against this backdrop, the massive economic shock triggered by the COVID-19 pandemic broadly tested the resilience of our financial system. As the pandemic unfolded, strains occurred across financial markets as investors dashed for cash amid widespread lockdowns and fears about the economic and financial outlook. Mortgage markets in particular began to show significant signs of stress. The MBS market, like those for other fixed income securities, became extremely volatile. And with the unemployment rate spiking, market participants worried that borrowers would be unable to make their mortgage payments. The Federal Reserve's response to this crisis, which was prompt and forceful, included moving the policy interest rate to the effective lower bound, conducting large-scale purchases of Treasury securities and agency MBS, and implementing a number of emergency lending facilities to support the continued flow of credit to families, businesses, nonprofits, and state and local governments. On the fiscal policy front, the CARES Act, or the Coronavirus Aid, Relief, and Economic Security Act, provided economic stimulus checks and enhanced unemployment benefits to individuals, as well as eviction moratoriums for renters and a requirement that mortgage servicers grant borrowers up to 12 months of forbearance. All of these policy responses were crucial in easing the stresses in financial markets and helping us weather the period when much of the economy was shuttered. An unfortunate consequence of the mortgage forbearance measure was the pressure that it put on the funding needs of servicers, particularly mortgage companies, which are required to continue advancing payments on loans that are in forbearance. In April, Ginnie Mae alleviated these strains somewhat by announcing a grant program that provides servicers with financing for principal and interest advances, which would not be considered a default by the servicer. Similarly, in April, the Federal Housing Finance Agency, or FHFA, announced that servicers would be required to advance only 4 months of missed payments for GSE loans. So let's take a look back. Although we continue to closely monitor the path of the virus and the public response to it, economic and financial conditions have improved much more than many had expected in the spring. And it's a great relief that the most dire scenarios that seemed possible in the spring have not come to pass, which is largely due to supportive fiscal and monetary policy. In addition, the near-term stresses in financial markets have abated, providing support for the very strong economic recovery to date. The Federal Reserve's interest rate actions and MBS purchases have contributed to exceptionally low mortgage rates, which have boosted housing demand and the associated mortgage originations for new home purchases. We're also seeing a surge in mortgage refinancing. And as a result, mortgage companies have experienced an influx of cash and an increase in profitability, and they have not had difficulties financing the advanced payments. To date, mortgage delinquencies and the take-up on forbearance appear to be limited and well below the early fears of significant problems. The increase in employment since April, income support from stimulus payments, programs such as the Paycheck Protection Program that helps small businesses retain workers, and enhanced unemployment insurance all helped borrowers continue making their mortgage payments. And forbearance provisions in the CARES Act to homeowners with mortgages securitized by the GSEs or Ginnie Mae, which is around 65% of the outstanding mortgages in the US, have so far helped prevent foreclosures, which also supports home prices. The share of mortgages in forbearance rose above 8% last spring, but it's since fallen to below 6%. And of those loans in forbearance, about 1 in 6 are current in their payments, reflecting the broader economic recovery. This improvement has not been uniform, though, and the decline in the forbearance rate for loans in Ginnie Mae pools has been slower than those in GSE pools. And of course, significant uncertainties remain, including the fact that forbearance for federally backed mortgages is set to expire in the first quarter of next year. So we'll now talk about some of the lessons that we've learned. So even as we take some comfort in these positive developments, we're also giving due consideration to the financial market vulnerabilities that were made evident in this crisis, and we're examining ways that we can address them. One prominent vulnerability, which I've described here today, relates to the funding and liquidity profile of mortgage companies. In different circumstances, the large-scale delinquencies and defaults we saw last spring could have caused some mortgage companies to fail, especially if the surge in origination and refinancing income had not materialized. Because many mortgage companies both originate and service mortgages, strains in these firms' servicing books could also weigh on their origination activities. As I noted a moment ago, any reduction in credit activity or availability would be most acute for borrowers from traditionally underserved communities, where mortgage companies have a particularly high mortgage market share. But even before the pandemic, regulators had widely recognized that the oversight and regulatory infrastructure for mortgage companies is much less well developed than for banks, and it could benefit from an update. To that end, Ginnie Mae announced new requirements for its servicers last year. The FHA announced that it will propose updated minimum financial eligibility requirements for GSE loan sellers and services. And more recently, the Conference of State Bank Supervisors proposed a set of prudential standards for state oversight of non-bank mortgage servicers. And finally, the Financial Stability Oversight Council, or FSOC, has been working closely with regulatory agencies to analyze risks related to non-bank servicers and to facilitate coordination among agencies. So an encouraging feature of all of these proposals is that they recognize the complexity of the mortgage company regulatory structure. The states are the primary regulators, but most large companies, mortgage companies, operate in multiple states, and they're subject to counterparty requirements from the GSEs and from Ginnie Mae. These proposals have all moved toward being more consistent with each other, which should reduce regulatory complexity and burden for mortgage companies and for regulators. But the harder task is thinking about what the overarching regulatory framework should be for mortgage companies. The risks that mortgage companies face are different from the ones that banks face. Mortgage companies will be more affected by shocks to the mortgage market than banks, which have much more diversified portfolios. As I mentioned, mortgage companies have less access to liquidity than banks. At the same time, they don't pose the risk of a claim on the deposit insurance fund. These factors suggest that the optimal regulatory framework for mortgage companies should differ from that of banks. But these are difficult questions, and a casual observer might wonder if it's really necessary to grapple with them, especially as the industry appears to have successfully weathered the strains of the past few months. But I would argue that this success was reliant on rising home prices, low defaults, and massive fiscal and monetary stimulus. But we certainly can't count on all of these factors being present in future periods of economic stress. Around the world, regulators are deliberating about how to address a variety of non-bank entities that can pose systemic risks. In work published last week, the FSB highlighted the need for a macroprudential approach to non-bank financial intermediation. Members of the FSB are not calling for bank-like regulation for non-banks, but they recommend a framework of supervision and regulation that takes into account systemic risks that can be posed by non-banks. I'd also note one lesson we learned in March, which is that conditions in financial markets can deteriorate very rapidly and very unexpectedly. So I'm paying close attention to the issues that I highlighted in my remarks today, and I'm keeping an open mind. But I do think it's clear that doing the hard thinking and planning now, at a time when conditions afford us the time to do so, is a very worthwhile investment. Our financial system and our mortgage market will be more resilient when they welcome and appropriately manage the risks associated with both bank and non-bank mortgage firms. Thanks so much for the opportunity to be here with you today. And thank you, Loretta, for having me.
Thank you, Governor Bowman, for those meaty and insightful remarks. And I'd like to thank everyone who has attended on the first day of the conference. I think your remarks made a nice keynote and capstone for our first day. And for all these, so once again, I would like to thank you. For all the people attending, we would appreciate your feedback and ask that you complete the conference survey following your time with us today or tomorrow. You can use the camera on your mobile device to complete the survey. And then look at the QR code on the screen or type in the web address and password listed on the screen that you see there to complete the survey. We actually use this survey and this feedback every year to enhance the next year's conference. Thank you again for joining us today, especially Governor Bowman, and we look forward to everyone to have you join us tomorrow for day 2. Hope to see you then, and this concludes day 1 of the conference. Thank you all.